Second reading of the Financial Services and Markets Bill. Lord Stockwood.
My Lords, I beg to move that this bill be now read a second time. My Lords, the financial services sector is one of the UK's greatest economic success stories. We are the world's largest net exporter of financial services, and it makes up around 20% of UK exports. The sector makes up 8% of UK GVA in 2025, totalling £224 billion. It plays a vital role in our economy, underpinning services that households and businesses rely on every day. It provides high-quality jobs all throughout the country. It was in recognition of this that the Chancellor announced a significant set of reforms in her speech to the sector in Leeds. I'm very happy to take this bill because I worked in the sector in the past. I was the CEO of an insurance technology firm offering protection to small businesses, and I've been on several boards of businesses in the financial services sector. While I no longer hold these roles, perhaps it is right moment to declare my interest. I set out in the Ministerial Register, in particular, a number of my investments in funds which are managed by regulated FCA firms. In my role as Investment Minister, I see and hear firsthand just how our financial services sector reaches the extent to which our institutions, regulation and rule of law are respected overseas. My Lords, the Financial Services and Markets Bill will modernise how the sector is regulated. It will enable it to grow and to lend more to businesses and make consumer protections fit for the digital age. It will achieve these objectives by maintaining high standards of regulation and oversight, ensuring that consumers and businesses continue to engage with the sector with confidence, and it will meet their needs. I'm pleased that the bill has been welcomed by a range of stakeholders operating across and alongside the sector, and there's a general recognition that there was in all peers meeting that I hosted this week that there's a question of balance that we're trying to achieve. As the noble Lords would expect, this is a large technical bill, so I'll briefly set out its purposes and why the government has adopted measures it has, and why we believe that they strike the balance of promoting innovation and growth while managing and mitigating risk and, of course, protecting consumers. Turning first to consumer protections and redress arrangements, Clause 1 and Schedule 1 repeal large parts of the provisions remaining in the Consumer Credit Act 1974, so that many of these can be recast into the rulebook of the Financial Conduct Authority, known as the FCA, continuing the changes introduced as part of the Financial Services Act 2012. The Consumer Credit Act was designed for the pre-digital age, where everything was done on paper forms. It predates the smartphone by over 30 years, and research shows that parts of the Consumer Credit Act can be harmful to potentially vulnerable customers, as lenders are often required to send complex communications that result in individuals feeling disempowered, confused, and reluctant to seek help. This shows how bad regulation can harm consumers. The FCA is already responsible for making rules that protect consumers and has already made rules to replace some parts of the Consumer Credit Act. It has the expertise needed to perform this role and the powers needed to appropriately police compliance within the rules. Repealing more provisions from the Consumer Credit Act will ensure that it can make rules fit for the digital age. Moving on, clauses 4 to 12 reform the operation of the Financial Ombudsman Service, known as the FOS, to improve the consistency and predictability of its decision-making. At the moment, in a small but significant minority of cases, the FOS is acting as a quasi-regulator, by which I mean that it's simply resolving individual complaints between consumers and firms as intended. Its decisions have the effect of setting minimum standards for firms. This can lead to uncertain and inconsistent expectations of outcomes for consumers and firms, which undermines confidence. The bill is reforming fair and reasonable tests as well, which guides FOS decision-making, introducing a mechanism to ensure greater coherence between the FOS and the FCA, and makes a number of other reforms to allow the FOS to successfully fulfil its original role as a quick and informal dispute resolution service. Clause 23 to 28 improve protections for consumers who purchase financial products through an appointed representative. For example, when purchasing insurance from a retailer acting on behalf of an authorised firm. The bill will require the FCA to check that an authorised firm is up to the job of ensuring its appointed representatives operate with high standards of conduct. And when something goes wrong, the bill will ensure that consumers of appointed representatives will be able to bring a complaint to the FOS, which is not always the case at the moment. Now let me turn to the regulatory framework. I would like to thank all the members of the House of Lords Financial Services Regulation Committee for their Growing Pains report that I read over the weekend. There's a strong alignment between this committee's conclusions in the report and the government's perspective and actions. The bill will consolidate the regulatory framework to deliver stronger coordination and clearer responsibilities. Clause 13 and Schedule 2 will abolish the Payment Systems Regulator, known as the PSR, and consolidate its functions within the FCA. The PSR has been effective in driving competition and innovation amongst payment firms, but the current framework is too fragmented. The bill will reduce the number of regulators that firms need to engage with. The bill also makes a number of reforms to support effective operation of the two largest financial services regulator, the Prudential Regulation Authority, the PRA, and the FCA. The actions of the FCA and the PRA are absolutely critical to ensure that the UK has the right regulatory environment, a key part of the government's financial services growth and competitiveness strategy. Clause 21 speeds up the regulated decision-making by reducing the statutory deadlines for determining a number of key applications, including authorising new forms. And clauses 29 and 30 create a new provisional licence. This regime will support innovative new firms by allowing them to begin operations on a temporary and limited basis while they apply for full authorisation. The bill also makes a number of changes to the internal operations of the regulators to ensure that they are focused on their activities in the right places and to support the effective oversight and scrutiny of their work. The government has looked to a wide variety of requirements currently applying to firms, some overlapping, some obscure, and some simply of low value. Clause 16 requires the regulators to develop and publish long-term strategies. Clause 17 requires the regulators to consider their existing 8 regulatory principles while preparing or revising their long-term strategies, while removing the requirement to consider them every time they exercise one of their functions. Clause 18 removes a number of requirements on the regulators that are duplicative or impose a burden on the regulators that is disproportionate to any transparency benefits that they bring. Collectively, these changes are designed to ensure that the Government and Parliament can give clear direction to the regulators at a strategic level and support scrutiny of their broader approach in a way that is meaningful and impactful, rather than focusing on the minutiae or clogging up the regulators with process that adds no value. The bill also supports the international competitiveness of our world-leading financial services sector, including through Clause 37, which enables the Treasury to create overseas recognition regimes to make business across the borders without compromising consumer or financial protections. I will now turn to the section relating to administrative burdens on firms. I've said that the bill ensures that the administrative burden that regulation puts on firms is proportionate without compromising on core consumer, prudential and market protections. At the core of these objectives are reforms to the senior managers and certification regime in clauses 31 to 36. This regime holds senior leaders in financial services firms personally accountable for their actions. This is a vital regime that was introduced after the failures of the financial crisis following the reports of 2012 Parliamentary Commission on Banking Standards. Many members of the House took part in that commission, including the noble lady Baroness Kramer, who I look forward to hearing from today. This regime has vastly improved the standards of governance and conduct across the financial services sector, and we have the Baroness Kramer and others to thank for that. However, the way that the regime operates in 2026 results in significant regulatory burdens, cost and operation inflexibility. Following careful consideration, the bill will reduce those burdens while retaining the core guardrails that the regime introduced. The bill gives the FCA and the PRA flexibility in how senior management appointments are overseen. The bill removes the certification regime, which applies to roles below senior manager level. In its place, regulators will be able to make appropriate rules in their rule books. Last week, I met with many noble lords, including the noble Lord Sharkey, the noble Lady Baroness Bowles of Berkhamsted, my noble friends Lord Davis of Brixton and Lord Pitt Watson. They asked me for assurances that the bill does not weaken the core protections of this regime. I am happy to give those reassurances. Firms will remain responsible for ensuring those they appoint are fit and proper, and individuals will remain individually accountable for their decisions. This is not about deregulation, but about ensuring the rules operate in a more proportionate and targeted way. I will now speak to the opportunities for credit unions. The bill will enable credit unions to serve more people and communities, something I know that will be strongly welcomed by many in this House. The government is committed to supporting the growth of mutual and cooperative sector, recognising the important role credit unions play in promoting financial inclusion and providing affordable credit. Clause 2 expands the common bond requirements of credit unions. It enables credit unions to reflect modern arrangements in our living conditions, allowing them to admit relatives of existing members who live outside the same household and members of the same household who are not relatives. It enables credit unions to permit retirees to remain as fully qualified members and to join credit union after retirement. And it enables credit unions to admit students as eligible members under the locality bond, even where they do not live or work in the same place as they study. This delivers on long-standing ask of the credit union movement, which the Chancellor is proud to be able to deliver. This is one of the government's ambition to double the size of the cooperative sector. On lending and investment, clauses 39 and 40 update the statutory framework underpinning the ring-fencing regime. This regime requires major banks to separate their UK retail services from riskier investment banking activities. I would like to take a moment to pay tribute to the Parliamentary Commission on Banking, whose work it was instrumental in establishing this regime. I want to be clear, ring fencing has played a central role in strengthening the resilience of the UK retail banking sector since the financial crisis. But it is also true that the wider prudential and resolution regime has developed significantly since then. In particular, the UK now has extensive resolution powers to protect depositors and taxpayers in the event of future failure. The UK is therefore now much stronger in its position to respond to banking failure compared to the global financial crisis. The Independent Skill Review of 2022 concluded that ring fencing should be retained, but identified areas of rigidity and recommended better alignment with the resolution framework. At Mansion House last year, the Chancellor announced a further review of ring fencing regime. And last month, the government set out a package of reforms designed to support growth while maintaining financial stability. The bill makes changes to deliver the outcomes. It clarifies that the regulator need not duplicate rules where protections are delivered elsewhere, and updating statutory purposes to reflect how banks could fail today. Overall, these changes create a more coherent and adaptable regime, supporting a more efficient environment for banks to lend and invest in the UK economy. And it does so while upholding financial stability and protecting depositors. The bill will also enable the Treasury to update existing legislation to help small and medium enterprises, known as SMEs, to access lending through a wider range of lenders. Legislation already requires certain banks designated by HM Treasury to share credit information about their SME customers, subject to consent, with designated credit reference agencies to encourage greater lending. Since that regime was introduced, the probability of SMEs establishing new borrowing relationships has increased over 25%. However, almost 70% of new lending to SMEs now comes from outside those core designated banks, including from newer challenger banks and fintechs. Clauses 41 to 43 allows the Treasury to expand the scheme to a wider variety of lenders. For the first time, the government is also extending the scheme to support the provision of credit to the charity sector. Clause 44 advances the government's ambition to make the UK the location of choice for specialist and complex insurance by enabling the PRA to set more appropriate funding requirements for specialist insurance undertakings known as transformer vehicles. Clause 45 advances the government's ambition to establish a new globally competitive captive insurance framework. And now to the subject of anti-money laundering. I have spoken about the importance of maintaining the UK's preeminent global position as a global financial sector. However, being a financial hub means we have now faced heightened vulnerability to illicit finance. Money laundering firms harm legitimate businesses by distorting competition, increasing costs and enabling organised crimes. The UK has set a robust set of anti-money laundering rules, but the supervision of those rules is not consistent. So in October 2025, the government announced its intention to reform the supervision framework, with the FCA becoming the supervisor of compliance with anti-money laundering and counter-terrorist financing rules for professional service firms. The detailed implementation will be through secondary legislation. Clause 14 will allow the FCA to take responsibility for supervised anti-money laundering and counter-terrorist financing amongst these professions. This will mean more consistent and effective supervision and improved collaboration with law enforcement. Financial crime increasingly takes place via crypto assets, and those assets are increasingly held outside the UK. Several pieces of legislation enable government to seize illicit crypto assets with a connection to the UK. However, these powers have not been working effectively. The bill enables the government to ensure the work intended and can be modified as criminal practices evolve. Finally, Clause 3 gives the government the power to act on access to banking services. The way people access banking services in the UK has changed significantly over recent years. More and more of us are banking online, and banks are closing branches in response. The government is committed to ensuring that those customers who need it retain sufficient access to essential banking services in person. Banking hubs play a critical role in this ambition, and we remain committed to supporting the financial services industry's rollout of 350 banking hubs by the end of this Parliament. Last month, the government launched an independent review into access to banking services led by Richard Lloyd, former Which Director and former board member of the FCA. This review is to better understand the impact of the current trajectory, including the scale of any detriment to consumers, particularly vulnerable groups. The bill contains a power to take action on access to banking services, including implementing the outcomes of the review should the evidence demonstrate that this is necessary. My Lords, I've only been able to touch briefly on what is clearly a wide-ranging bill. I look forward to discussing it in more detail. This bill will help financial services sector grow and to lend to more businesses, and importantly, make consumer protections fit for the digital age. When I began my speech, I said that the bill is a matter of balance. I hope the noble Lords will agree that this bill achieves its modernising objectives while maintaining the UK's high standards of regulation and oversight. My Lords, I beg to move.
Is this bill be now read a second time?
My Lords, it is a pleasure to follow the noble Lord the Minister as we begin our deliberations on the Financial Services and Markets Bill. Now, like him, we believe that financial services are one of Britain's great success stories, a sector that accounts for around 12% of GDP, supports 2.5 million jobs, and contributes roughly 110 billion in tax each year. It's not simply a sector to be regulated, it is, my Lords, a national asset to be championed. We need the sector to grow because that will benefit us all. Turning to the economy overall, we have had, unfortunately, a lengthy period of low growth following the financial crisis of 2007 and 2008, and there is no sign of imminent recovery. Expectations are now for low UK growth in 2026. This continuing trend must be reversed. The government's rhetoric on the importance of growth must now be matched by serious action. Too often, warm words have been followed by policies that pull in the opposite direction. The bill comes after a tidal wave of anti-growth measures, of which the Employment Rights Act is only the latest example. It is our view that a major factor in our low rate of growth is over-regulation, and that this is especially true of the financial services sector. Now, our Financial Services Regulation Committee agreed, and it's good to see the chair, my noble friend Lady Noakes, here today. Their excellent report, Growing Pains, Clarity and Culture Change Required, which the Minister has already referenced, warned that the regulatory pendulum has swung too far towards elimination of all risk. My Lords, that matters because an economy that seeks to eliminate all risk will, in the end, eliminate growth as well. The consequences are already being felt. International firms are looking elsewhere. Businesses already operating here face costs that make the UK less attractive and less competitive. And the CEO of Marsh McLennan told the committee that from a regulatory perspective, the UK is at least 6 times more expensive than our next most expensive country. That's an extraordinary warning and one the government should take seriously. So the question is whether this bill measures up to what is required to meet the concerns of the committee and the wider needs of growth. I fear that once implemented, the bill will not lead to the step change required. As we take it through the House, a major perspective from which we will be judging it is its likely effect on growth. However, several in several respects, the bill is moving in the right direction. There is a broad consensus that reform is needed. The Treasury itself has acknowledged that the United Kingdom has been left with an overly complex system, and the National Audit Office has pointed to delays between problems being identified and regulatory action being taken. Industry has been saying the same thing. UK Finance has made clear that the Consumer Credit Act is outdated and no longer reflects the protections needed in a modern digital market. And the City UK has called for a more coherent, streamlined post-Brexit framework. We therefore welcome in principle the proposed changes to credit unions and the proposed transfer of the payment systems regulator into the FCA. The changes outlined to the Financial Ombudsman Service are also positive, and we expect that this will bring some further clarity to their role and to the regulatory landscape more widely. We also welcome measures designed to reduce approval timelines and to reform the senior managers and certification regimes. Accordingly, the greatest problem with this bill is not what is in it, but what is missing from it. For example, it contains nothing on financial education, so key to improving our savings and investment culture and performance. More important, whilst the legislation before us removes significant amounts of old regulations, it has extensive powers to the Treasury and to the regulators to design what comes next. Yet Parliament is being asked to approve the transfer of power without seeing in sufficient detail the regulatory framework that will replace what is being repealed. The incredibly broad powers set in Clause 3 on in-person banking is a good example. The repeal of a large volume of consumer credit architecture with the expectation that much of what is removed from statute will later be recast into FCA rules transfers responsibility for policy making from Parliament to the FCA. So that's another example, and we believe that this is unwise. Moreover, the obscure provisions in Clause 14 of the bill on anti-money laundering appear to give the FCA and PRA new powers to extend regulations and impose burdens on a number of professions not currently so regulated. We are told by some that this is a deregulatory bill, and that is welcome. But deregulation ought not to mean removing rules from primary legislation and recreating them elsewhere beyond proper parliamentary scrutiny. The test is not just whether the statute books look thinner, but whether the burden facing firms is actually reduced. Now, I'm sure the Noble Lord the Minister will point to the regulator's growth and competitiveness objective, but the Financial Services Regulation Committee was clear that this objective has not yet translated sufficiently into policy or practice. Recent history does not give us confidence that a culture of risk aversion, delay, and excessive caution will correct itself without stronger statutory direction, clearer accountability, and more effective parliamentary oversight. There is also a wider question about whether the regulatory framework being created will be fit for the future. The Minister touched on this. Financial services are changing at extraordinary speed, led by remodelling overseas, especially in the US. Digital assets are becoming more sophisticated and more integrated into mainstream finance. We're now discussing sovereign bonds on blockchains, digital settlement systems, tokenized assets, and new payment technologies capable of transforming everyday transactions. Yet industry is warning that the government still lacks a clear strategy for digital assets. As a result, firms face uncertainty, innovation is delayed, and business connected to digital asset activity risk being actually debanked. And I fear that other countries are moving faster in this area. The United Kingdom should be leading in this space. We have the legal system, the financial expertise, the history, the capital markets, and the international reputation to do so. We also need to have regard to the competitive interest of our UK firms. One very senior banker has warned me that the last-minute proposals on ring fencing would be welcomed by his overseas competitors, since it would reduce his competitiveness. There is also concern from our huge insurance industry, where the UK is a true world leader with 69% of income coming from overseas. They fear that downgrading the proportionality duty and confining its application to long-term strategies rather than to regulatory decisions will make the UK a less attractive place to do business. So before I close, I want to ask some questions of the Noble Lord the Minister. First, are present ministers determined that the regulations made under this bill will prove less onerous in practice than the architecture they replace? Second, what assessment has the government made of the FCA's operational readiness to take on the additional responsibilities conferred by this bill? Third, is the Minister confident that the measures in this bill will materially reduce delays in authorisations and approvals, particularly for smaller firms, for challengers and for new entrants? The ability to stop the clock without an independent arbitrator undermines the targets. And fourth, is the Minister confident that following the adoption of this bill, regulator behaviour will become more growth-focused? My Lords, there is a missed opportunity at the heart of the bill. It contains measures that we welcome, as I've said. It moves in the right direction. It recognises, at least in part, that the current system is too complex, too slow and too burdensome. For that reason, we will approach the bill constructively, and I look forward to working with the Noble Lord the Minister on many of the details, not least given his background in the sector that we are discussing. I hope and believe that there are medium-scale issues on which we can reach agreement in this House. But there are two broad problems as I see it. First, this is a bill that begins the process of reform but does not on its own meet the scale of the challenge. The test for this bill is not simply whether it makes technical changes to the financial services framework, but whether it helps make the United Kingdom once again the most dynamic, competitive, innovative and attractive financial centre in the world. Second, we are being asked to take a lot on trust because of the remarkable degree of delegation in the bill. We are required to trust that the regulators will deliver in a timely and effective way, to trust that the Treasury will deliver the necessary framework, and to trust that Treasury ministers will oversee the step change that we need. My Lords, looking to the past and to the volatility of current politics, can we really put so much trust in the proposals before us?
My Lords, I welcome this bill and the growth and competitiveness objectives that inform it. I want to thank many organisations that have provided us with briefings, and I want especially to thank the APPG for investment, fraud and fair financial services. Their 70-page analysis deals with each part of this bill in depth and reaches an important overall conclusion. That conclusion is that the case for protecting consumers within any reform of financial services is not merely a moral case, although the moral case is strong. It is an economic case grounded in a clear-eyed analysis of how trust works, how it is destroyed, and what happens to markets when it is lost. The report also notes that the bill should not simply make complaint handling faster or more predictable for institutions. It should ensure that ordinary people can get the real issue investigated, decided, escalated where necessary, and put right. It's not at all clear that the bill does this or does this sufficiently. A look at Part 2 of the bill illustrates the problem. It contains a number of significant reforms. Clause 5, for example, which concerns the appointment of the chair of the FOS scheme operator. Under this clause, the chair is appointed directly by the Treasury. This is a major structural shift that was not included in the original consultation. The clause also states that the terms of appointment must secure the chair's independence from both HMT and the FCA. The Ombudsman scheme occupies a unique position within our regulatory architecture. It must command the confidence of consumers while maintaining credibility with the industry. Independence is therefore essential and is not merely a matter of statutory wording. It's also a matter of perception. Where appointments are made directly by government, questions inevitably arise about whether sufficient distance exists between ministers and those exercising important quasi-judicial functions. Clause 6 also contains significant reform proposals. It addresses time limits for complaints under the compulsory jurisdiction. It introduces a long stop period of 10 years from the relevant act or omission, while preserving the possibility of alternative limits set through rules and allowing exceptions in specified circumstances. This is a process which, though critically important, allows no meaningful parliamentary scrutiny. It is, of course, true that there is a strong case for providing greater certainty. Financial firms should not face indefinite exposure to complaints relating to events that occurred decades earlier. It's also true that financial misconduct can sometimes take years to emerge. Consumers may not discover that they've suffered detriment until long after the original transaction occurred. The challenge is one of balance. Parliamentary involvement will be helpful. Still in Part 2, Clause 7 introduces one of the most consequential innovations in the bill, the referral of matters from the FOS to the FCA. The Ombudsman may also seek the FCA's opinion of FCA rules where ambiguity exists. This proposed reform reflects the concern that individual complaints can sometimes raise wider questions affecting thousands of consumers and firms. The proposed reform also reflects long-standing industry criticism that the Ombudsman has occasionally interpreted regulatory requirements different from the regulator. But in reality, it's hard to see this as a well-founded or convincing criticism of the current setup. The FOS resolves over 200,000 cases each year, upholding about 30% or so. We're told that the FOS is acting inconsistently, that it's strayed into becoming a quasi-regulator. If that were true, if this were really a systemic problem, then the government should be able to produce a substantial body of evidence. If it were true, then there should be hundreds or even thousands of FOS decisions demonstrating this pattern. If such a list exists, HMT and the FCA have not published it. It's certainly not in the impact assessment. And if such a list does not exist, then the case for much of the reforms to the FOS rest on assertion rather than evidence. I invite the Minister, when he replies, to point us towards the specific FOS cases that justify the proposed sweeping reforms. As things stand, the government appears to be jumping to conclusions that will reduce access to the FOS, reducing access to free and impartial redress, introduce extra bureaucracy and costs, and ultimately damage confidence and trust in the financial services industry. We must guard against any risk that the Ombudsman becomes subordinate to the regulator or loses the independence that has been central to its legitimacy. There is a strong case for removing Clause 7 from the bill. Clause 8 reforms the test used when determining complaints under the compulsory jurisdiction. This may well be the most controversial provision in Part 2. Historically, the Ombudsman has determined complaints according to what is fair and reasonable in the circumstances. Critics have argued that this has sometimes allowed decisions to diverge from the regulatory rulebook, creating uncertainty for firms that believe they had complied with the FCA requirements. We should ask ourselves whether strict alignment with regulatory rules could weaken consumer protection in cases where the rules themselves are incomplete, outdated, or silent on emerging risks. The strength of the Ombudsman system has been its ability to look beyond technical compliance and to consider fairness in a broader sense. If that flexibility is narrowed too far, some consumers may find that conduct was plainly unfair, nevertheless escapes effective remedy. There are already voices, such as the Centre for Responsible Credit, calling for the removal of Clause 8 from the bill. And Step Change has said the fair and reasonable test was carefully designed by Parliament, requiring FOS to consider all the circumstances of the case. In contrast, the FCA rules are often high-level and permissive. We believe that the scope and flexibility of the existing test is essential for the FOS to decide cases in a manner that is fair. Shifting this to be based on compliance with FCA rules risks creating a tick-box exercise and weakening consumer protection. Martin Lewis has warned that restricting access to free and fair redress is not a recipe for economic growth. Once consumers are warned about the erosion of their rights, it's possible this will lead to a disengagement from financial services and diminishing trust. On this issue, as on others in the bill, Parliament must ensure that in pursuing regulatory certainty, we do not sacrifice fairness, that in pursuing efficiency, we do not diminish accountability, and that in strengthening regulatory coordination, we do not weaken the independence of the Ombudsman. The UK's financial services sector thrives not merely because it is competitive, but because it is trusted. And to be trusted, consumers must have confidence that when things go wrong, there is an independent, accessible and effective route to redress. The bill may not expressly repeal consumer protections or statutory rights, or the concern is more subtle. Rights created by Parliament may be diminished in practice if access to redress depends on FCA rule compliance, FCA intent, FCA interpretation, or Treasury-made conditions, rather than independent interpretation of the underlying legal issue. And I close by quoting which, the proposed reforms to the FOS and the FCA appear to come at the expense of consumer protections. Any benefits arising from weaker consumer safeguards are likely to be temporary, while longer-term costs could be significant, particularly for vulnerable who rely most on access to redress and effective regulatory protections. My Lords, I agree with that.
My Lords, before we move on to the backbenchers, can I just remind noble Lords that the time limit or advisory time limit is 8 minutes. If we can all stick within that, we can get everybody in, it's fair to everybody else, and we'll be able to finish at a reasonable time as well.
My Lords, this bill is another example, I'm afraid, of my past catching up with me. It was 27 years ago that I was asked to chair a joint select committee of both houses to scrutinise the draft Financial Service and Markets Bill that was introduced at that point. The committee met for 3 months and published 2 reports. I believe Lord Eatwell is the only other member of the committee still in this House. And it was that, of course, that then became the Financial Services and Markets Act 2000, which all of the subsequent changes that have taken place, including 2012 and others, has followed as being the amendment of that act that was put in place. I should also note my interests in this legislation as outlined in the Register. I own shares in Banco Santander and Flagstone Group. Furthermore, I was chairman of Abbey National and then Santander UK from early 2002 until 2015. It is worth recalling just for a moment some of the factors that lay behind the need for the bill back in 2000. The first, of course, had been the decision by Chancellor Gordon Brown to remove banking supervision and regulation from the Bank of England and to transfer those responsibilities to the proposed Financial Services Authority. Second, this provided the opportunity to consolidate various financial regulatory bodies that had previously operated independently, and these included, and this is just the beginning of the list, the Building Societies Commission, the Securities and Investment Board, several self-rating bodies, the various ombudsman schemes. In fact, it's really quite astonishing to now think back just how complicated and how complex the arrangement was before the 2000 Act. And of course, third, there had been, as there always seems to be, problems with a number of financial institutions, including, we had, even during the time I was Permanent Secretary, the closure of BCCI, the collapse of Barings, some difficulties with smaller banks. And before that, there had been the collapse of Barlow Cloud. So there were quite a lot of lessons to be learned in which the bill was aimed at trying to put into a comprehensive framework. The committee agreed and with the government, and one of the significant issues that came up was that the appropriate approach to this legislation was that it should be principle-based rather than rules-based. Even then, the financial services industry was growing rapidly. The building societies were in the process of becoming banks. The banks were getting themselves involved in the mortgage market. And a principles-based approach was seen as the most practical way to ensure the regulatory process remained fresh and relevant as these changes progressed. Now, as explained in the explanatory notes, this approach does involve a three-stage process, and it can make it look very complicated. And some of the issues we've already heard from Baroness Neville-Rolfe are the product of the way in which this was designed, because the way it was designed, and I think is the case as it remains, the primary legislation, Parliament sets the overall regulatory framework in primary legislation, including the regulator's objectives. The second step, the Treasury then sets the regulatory perimeter through secondary legislation, including specifying which activities are regulated and in what circumstances. And then the third step, the PRA and the FCA operate as independent statutory bodies who are responsible for setting and enforcing the detailed rules for firms engaged in regulated activities. And some of these issues about when and what should come to Parliament, what should be in delegated responsibilities, and who, how far the regulators are allowed to set the rules, are always going to be issues which overlap each other, and people will worry about them at various stages. But I think it is important throughout the discussion and debates that will take place, to keep recognizing that from the beginning it has been this sort of three-stage process that has been in mind. Personally, I believe the principle-based legislation has been effective for this fast-moving industry. However, achieving the right regulatory balance, as we've heard this afternoon already, at any time is actually very challenging. Sometimes regulation becomes overly burdensome and the economy suffers. At other times, insufficient regulation can lead to consumer harm, detriment, or failure of firms. And lots of factors influence this balance, including external developments, product innovation, the expectation of customers, and the level of effective competition. And it's therefore, and I feel very happy with the fact that it is important to periodically review these various components of the principle-based approach and assess their effectiveness and determine if any rebalancing is necessary. And for myself, many of the changes that are proposed here I regard as very sensible rebalancing of some of the factors involved. In the past, of course, the rebalancing has happened on several occasions. Following the financial crisis, it became clear that banks' capital requirements were insufficient during the run-up to the crisis. It was demonstrated clearly in a subsequent FSA report into RBS. Banks had held too little capital against complex products that they were dealing with. Many banks were overly reliant on the interbank market for funds, with lending over-concentrated in the real estate market. And subsequently, of course, the FSA and the FCA rightly raised capital and liquidity requirements. The question, of course, is, did they change it by the right amount? Was it not sufficient, or was it excessive? At the time, of course, it was understandable. We'd been through this very painful process. But for myself, to me, the later evidence suggested that, in fact, the response had been excessive. It contributed to a sharp reduction in bank lending to the private sector, particularly to SMEs. This, in its turn, has had, of course, some substantial knock-on effects. Given this subsequent evidence, my view was that some rebalancing of the capital requirements is appropriate. I think that the ring-fenced banks should also be looked at just what the size is of the ring-fenced around which they operate. It's also important, of course, to recognise that the rapid growth of new products also led to under-regulation of some products at times and leading to consumer detriment. Product details were not always clearly communicated to customers, as we would expect today. But this has got to be seen against the huge success of the introduction of internet banking. It's also important to ensure that senior people working in the financial industry are fit and proper. But again, the question is of balancing the whole question of bureaucracy against, and whether the question is raised of a less onerous approach. So this is a dynamic system. Getting the right level of regulation right has to evolve over time, but it's never going to be a straightforward task. And I regard this bill as an important part of trying to move forward that rebalancing.
My Lords, I declare my interest as set out in the register, as with all my colleagues on these benches, there seem to be many of them here today. My stipend, pension contributions, housing and working costs are provided by the Church Commissioners for England as an issuer of bonds, something we started when I was chairing. They're a regulated body. I welcome the intention behind this bill to modernise our financial services and to support economic growth. However, our aim must be to enable economic opportunity for all communities. In the midst of what's still a cost of living crisis, we must measure economic success not only by the growth of the economy itself, but also how it promotes the dignity of those who are most in need and protects individuals at times when the system fails. It's a large bill. I'll focus on just a few main aspects: access to credit, credit unions, consumer protection, and access to wider banking services. I think those are probably the issues most appropriate for one who's a bishop and not a banker. Access to fair and affordable credit, my Lords, is not simply a financial issue. It's a matter of dignity, equal opportunity and participation in community life. Deepening poverty across the UK is making it more difficult for people to break free from debt. Almost everybody needs to borrow money at some point in their lives, yet too often it's those with the least who end up paying the most. They face a poverty premium. They have fewer options. Christians Against Poverty, a wonderful charity, has found its clients are now borrowing money simply to pay for food, clothing, rent, utility bills. For many, credit has ceased to be a tool for flexibility. It's become a necessity for meeting basic needs, and that drives you deeper into debt. And debt fosters feelings of shame, of fear, of hopelessness, which often prevent families then from reaching out for support. Christians Against Poverty quote that 46% of clients they surveyed had actually gone as far as considering ending their own lives because of debt-related pressures. But also we can't overlook the emotional toil of financial insecurity on real lives. The inaccessibility of credit for underserved communities creates a significant gap in financial policy where these effects could be alleviated. And as such, I do strongly welcome measures in this bill aimed at addressing the problem. But these efforts must be sustained, they must be targeted. We must ensure those facing the greatest barriers are not left behind. Well, Lord, I was first involved in setting up a credit union almost 40 years ago. It astonished me just how small the sector was in England. It has grown a bit since then. There's 2.16 million people in Great Britain are now members of a credit union. And we do have a credit union for Church of England and other clergy. But Britain still compares poorly with other similar economies in what is, across many nations, a network of trusted, community-based saving and borrowing solutions, particularly for those communities least well served by conventional banking. Hence, my Lords, I strongly welcome the measures in this bill to promote the expansion of credit unions, including, critically, the broadening of common bonds to increase the number of people who are able to access this kind of credit. This measure is particularly important for serving those in more deprived areas where they may not previously have had access to banks or similar opportunities. Whilst expanding credit unions will go a long way towards improving access for many customers, it still remains the case that certain communities, think of those who are migrants or individuals with less financial literacy, remain excluded from credit opportunities offered by the mainstream banks. So what might the government consider doing to further improve transparency and accountability among mainstream lenders in how they can also serve marginalised groups alongside an expanded credit union sector? Turning to financial protections, increasing credit availability is an important step forwards, but it must be met with adequate protections to prevent mis-selling or over-borrowing and to ensure proper redress when things go wrong. Whilst I understand that the proposed changes to the Financial Ombudsman Service are designed to streamline the process, I'm concerned that stricter criteria there may make the whole process more inaccessible and less robust. Some proposals, such as stricter time limits on making complaints, may present barriers to certain consumers making claims in the first place, particularly when they may only discover the issue after many years. I also wish to echo concerns expressed by Noble Lord Sharkey regarding the proposed reforms to the Consumer Credit Act. Whilst modernisation is clearly needed, the shift away from detailed legal protections towards regulator-led rules may reduce, as others have said, parliamentary scrutiny, and we can establish routes to redress. It may also reduce certainty for consumers, making it less clear when they're entitled to redress and how they can secure it. And that is likely, again, to have the greatest impact on those who are less financially literate and who may struggle to navigate complex financial systems alone. For the more existing protections, such as those offered by Consumer Duty, don't provide protection to communities who are excluded from credit access in the first place. Without real effort from mainstream providers to incorporate underserved groups in credit opportunities, those most in need of support will continue to fall through the cracks. It's therefore essential that protections evolve alongside access, ensuring that increased participation in financial services doesn't come at the expense of security. And I'll follow with interest the debate about how much really ought to be on the face of this bill and how much can safely be left for later regulation. I do welcome the government's proposed scheme to improve financial literacy in schools by 2028, but that's no replacement for adequate routes to redress, democratic accountability and fair and equal access to credit to everyone who needs it. And finally, I suspect many of you in your Lordship's House nowadays access all of our banking services electronically. I can't think when I last went into a bank or even rang one up. There are those in our communities who need access to in-person banking services beyond mere cash. Financial exclusion fosters real-world isolation. Many of the communities the Church supports, elderly people, disabled populations, face greater barriers to financial independence in an increasingly digital age. And my lords, I'm not sure we're doing quite as much as we should in this bill to ensure in-person services beyond cash are available in both urban and, of course, rural settings. So, my lords, this bill does, I think, present an important opportunity, not only to modernise our financial system, but also to ensure it serves the common good. We must reflect not only on how this bill will enable growth, but also on how it might promote justice, equality of opportunity, and dignity for those communities who are most in need. I look forward to engaging with its progress through your Lordship's House.
My Lords, I thank the Noble Lord the Minister for his excellent introduction to what is a complex technical bill. In my contribution as the Prime Minister's anti-corruption champion, I will focus on a part that may not be at the top of everybody's agenda and wasn't on the Minister's top part, but for those of us who are engaged in efforts to tackle the challenge of dirty money, it comprises an important and welcome proposal set out in Clause 14. Tragically, Britain has, over recent decades, become the destination of choice for too many wanting to hide or launder their dirty money. The National Crime Agency estimate that £100 billion is laundered annually into the UK. Academics estimate if you add this to the money lost through fraud, the cost of economic crime to the UK rises to £350 billion. That's more than 5 times what we spend on schools in England, or nearly 6 times the amount Britain currently spends on defence. It's huge, a loss that harms our economy, undermines trust in the integrity of the financial services sector, threatens our security, and damages our public services. But the guilty criminals responsible for these crimes don't invent the schemes used to hide or launder their ill-gotten gains. They depend on the advice of professional enablers, accountants, lawyers, banks and company service providers, who devise the schemes and either enable, facilitate or collude with the economic crime. Most professionals work in both a lawful and ethical manner, but sadly there are some bad apples in the professions who must be rooted out and punished. At present, the professionals are not adequately supervised and identified, and too often they are left free to pursue their highly profitable but immoral and in some cases unlawful practices. Introducing a robust, efficient and effective supervisory scheme for vigilantly vetting the professionals should have a dramatic impact on the incidence of economic crime. Punish and get rid of the bad apples, and wrongdoers will lose their access to advice and support on how to hide or launder money. At present, there are 22 separate organisations that supervise accountants and lawyers. Many of these bodies also act as advocates for their members and do not have effective systems in place separating their regulatory and advocacy functions. There are further 3 government bodies that supervise other relevant professionals. OPBAS, the body tasked with supervising the supervisors, recognises that the current system is inadequate. In their March 2026 report, they say that the supervisory bodies, and I quote, continue to perform poorly in their enforcement approach, and some aren't undertaking consistent, proportionate and sufficiently dissuasive disciplinary measures in circumstances where it would be warranted and justifiable. Statistics confirm this judgment. The Chartered Institute of Taxation found that 31% of firms they visited were not compliant with anti-money laundering regulation, yet only 4 were disciplined, 3 were fined and 1 was suspended. The Council for Licensed Conveyances imposed no fines at all, despite finding that 62% of firms they supervised were non-compliant. The Solicitors Regulatory Authority cancelled the membership of just 1 professional body in 23-24, and the fine imposed on Michel de Rare in 2022 for multiple breaches of the AML regulations was £232,500. It would have been 5.4 million had it been calculated by the rules used by the FCA. So I strongly support the government's proposal to merge the supervisory body into one body that will operate within the FCA. This creates a simpler, more consistent framework, better placed to work with law enforcement agencies that will have access to data, allowing a joined-up approach across the professional disciplines. I would, however, seek some assurances from the Minister to strengthen the effectiveness of the proposed change. To ensure that the FCA properly prioritises this work, will the government ring-fence the funding the FCA will receive in fees from legal, accountancy and company service provider firms, and ensure that those resources are used to fund their supervisory and enforcement duties on money laundering? Will the FCA maintain a register of supervised entities, as they do for financial institutions, so that companies providing unlawful services that are not registered can be identified? Will the government ensure that data collected as part of the supervisory process can be shared with law enforcement agencies, and that those agencies share their information with the supervisory arm of the FCA? Will the government ensure that the FCA can access legally privileged documents from law firms where that is required for regulatory purposes? And will the government ensure that the FCA uses the enforcement powers in relation to professional services firms that it currently employs in relation to financial services firms? The threat of robust enforcement is always an effective deterrent to bad behaviour. Finally, I'm concerned, my Lords, that this excellent proposal will take time to implement, and I'm worried as to how effective supervision will be maintained during this period of transition. Would the Minister say what he proposes to do to ensure that supervision of professionals is as robust as possible? Can I suggest that he gives OPBAS the power of public censure so that it can name and shame those companies that deliberately fail to abide by the AML regulations, or that OPBAS levies fines against those supervisory bodies that fail to fulfil their obligations, and that OPBAS is also given the power to remove supervisory responsibilities from those who fail to fulfil their duties? And would he consider creating a duty to ensure that the existing bodies cooperate with the FCA during the transition? My Lords, I welcome the proposal. I look forward to working with the government to strengthen its effectiveness and to protect the supervision of professionals during the transition to the new scheme.
My Lords, may I begin by drawing attention to my interests listed in the register. My Lords, the financial crisis of 2007 to 8 and 9 left lasting scars on the UK financial system. The costs of that crisis have reverberated in the form of embedded risk aversion, particularly amongst financial services regulators. Yet, of course, risk aversion has its uses. Since the 2009 crisis, the financial services industry has been battered by further successive crises: Brexit, COVID, the wars in the Ukraine and the Middle East. It's to the credit of the Bank of England and the financial services regulators that the industry has displayed a remarkable level of financial stability throughout these storms. Yet there remains a persistent dissatisfaction with the performance of the regulators. The costs of compliance are excessive. A PwC study puts the sector's annual compliance bill at nearly £35 billion, roughly 13% of total operating costs. Regulators are said to take excessive time over crucial decisions such as authorizations. There is no consistent cost-benefit analysis of regulatory measures, despite the fact that the 2023 FSMA required the FCA and the PRA to establish cost-benefit panels. And regulatory decisions often create uncertainty, stifling innovation and discouraging investment. The fact that this bill addresses some of these concerns is certainly to be welcomed. The simplification of the senior managers regime and other administrative requirements should reduce costs. The new provisional licenses should speed up effective authorization. The changes to the relationship between the FOS and the FCA will perhaps reduce regulatory uncertainty. They may have other effects, as the noble Lord, Lord Sharkey, suggested. Moreover, the increased flexibility provided to the FCA and the PRA in several sections of the bill must be used with care, lest flexibility generates uncertainty. I am, however, whilst welcoming these measures, concerned by the changes to ring fencing. The claim in the explanatory notes that, quote, updating the statutory framework underpinning the ring fencing regime is part of a wider programme of ring fencing reforms, unquote, sets alarm bells ringing. Updating may well be the origin of increased systemic risk. The protection of activities within the ring fence must be a primary objective. Weakening the ring fence in the name of financial innovation would be unacceptable. Moreover, the claim that, and I quote again, these reforms will unlock more finance for the UK economy actually sets alarm bells ringing even louder. When he sums up, could the Minister enlighten us as to the content of the, quote, wider programme of ring fencing? What exactly does the government have in mind? Now, it's claimed in the explanatory notes that this bill modernises how the financial services is regulated, supporting it to grow and to lend more to businesses. But overall, the bill gives the impression of tidying up rather than embedding a greater financial commitment to investment and growth. Of course, the emphasis on investment and growth is surely correct. It's necessary for the economic well-being of the people of this country. In this vital respect, for many years, the financial services industry has failed, and it is continuing to fail. Since the year 2000, the share of financial services in GDP has grown by 50%, from 6% to 9% of GDP. Over the same period, the share of investment in GDP has not grown at all, and indeed has tended to decline, and has been persistently lower than in other major industrial countries. Now, we have to reflect on the fact that the prosperity of the UK's financial services sector is not solely a success of private enterprise. It is a success of a particular institutional framework in which public authorities and the market are deeply intertwined. The prosperity of the City of London depends upon the global prestige of English law and the public institutions that enforce it. Similarly, financial services depend on the public provision of a stable monetary framework and a respected code of financial regulation, ranging from the role of the Bank of England as lender of last resort and guardian of systemic stability to consumer protection and the prevention of financial crime. Public provision defines the environment within which financial services prosper. In return, financial services should work in a way that serves society by funding the investment in innovation, productive capacity, research and skills the country needs. That is the settlement between the public realm and financial services. My lords, it's a settlement that's not working. A new settlement is required. What might a new settlement look like? It should begin with a framework of financial institutions committed to the needed investment. And by that I don't mean greater flows of funds into stocks and shares and bonds in secondary markets. Britain needs financial institutions that fund real investment, new research, new products and services, new infrastructure, new homes, new international competitive industries. Now, the government's made an attempt at this by creating the National Wealth Fund. But the National Wealth Fund will invest only if a firm that seeks funds from it has already acquired private sector funding. In other words, an institution that exists because private markets have failed defers to those failing markets to guide its own investment decisions. That's just not good enough. But the new settlement must not solely rely on government, regulators, or even politicians. The financial services industry itself must play its part, building on current initiatives such as the Capital Markets Industry Task Force convened by the London Stock Exchange. The bill before us is not part of this new settlement to which I refer. It's worthwhile, it's sensible, but the task of building a financial services industry that truly serves our society needs to go a lot further.
My Lords, I declare my interests in that I hold shares in a number of listed financial services companies. It's a pleasure to follow the Noble Lord Eatwell, who is one of the select group of noble lords who regularly take part in the scrutiny of financial services legislation, and I welcome the Minister to our club. There is much in this bill which is good. In particular, I welcome clauses dealing with the SMCR regime, to how the FOS works, and the transformer and investment insurance vehicles. In addition, the changes to ring fencing are positive, but I do not think they go far enough to roll back this burdensome regime, which cost billions to implement and run, and is so flawed that not a single other country has adopted it. There are, however, several areas of the bill which I shall be looking to improve in committee. I'm going to focus my remarks today on just one area, which is Clause 17. Now, the PRA and the FCA currently have to have regard to the regulatory principles in Section 3B of FSMA, and that applies to everything that they do. Clause 17 downgrades that so that the principles are being rendered impotent. If Clause 17 becomes law, the regulators will merely have to talk about the principles in the new 5-year strategies required by Clause 16. Now, the regulatory principles were certainly due an overhaul, but neutering them is a shockingly bad decision by the government, and it is not surprising that many in the financial services sector have criticised it. I'm going to frame my remarks around the regulatory principle of proportionality, though what I say applies to other elements of the principles. Proportionality requires burdens imposed to be proportionate to the benefits expected to result. Now, this is manifestly something which ought to be uppermost in the mind of the FCA and the PRA when they are designing new regulatory burdens or updating existing ones. The lack of proportionality in the way that regulators currently operate is one of the key criticisms made by financial services firms. Now, I do not doubt that the proportionality principle is relevant when regulators develop their long-term strategies. Strategies, however, tend to be high-level abstractions. They are not blueprints for how regulation actually works in practice. It is the detail of the rules and the guidance, rather than strategic statements, which actually determine how regulation impacts the financial services sector. Now, the effect of Clause 17 is that the regulators no longer have to consider how the detailed rules and guidance actually work in practice for the various firms they regulate from a proportionality perspective. The regulators will be entitled to ignore representations made about proportionality during any consultation phases. Now, this downgrading not only directly affects how firms can engage with the regulators when rules or guidance are developed, it also, importantly, impacts the accountability of the regulators, which is already problematic. Now, the regulators like to say they are accountable both to the Treasury and to Parliament. I have not yet found an example of how the Treasury has held the regulators to account, and focusing on strategic plans will not be enough. The regulators are masters of the art of wordsmithing documents to make them attack-proof. Parliamentary select committees try to grapple with holding the regulators to account. But, my lords, it is an uphill battle, and this bill makes that battle harder. Now, the root problem is the FSMA model. As the Noble Lord Burns explained, under the FSMA model, Parliament decides the principles of regulation, and the regulators are left to get on with the detail of regulation. Now, that worked pretty well while we were in the EU, where the quasi-democratic processes of the EU Parliament, in which the Noble Baroness Lady Bowles of Berkhamsted played such a central role, meant that there was significant oversight of new directives and regulations. Post-Brexit, the previous government decided to continue with the FSMA model when the huge body of retained EU law was repealed and replaced, so that massive areas are now wholly delegated to the regulators. That is what the 2023 Financial Services and Markets Act enabled, and it exposed a large accountability deficit. In partial mitigation, the 2023 Act ensured that the regulators' consultations had to be sent to the select committees of each House of Parliament. And that Act also paved the way for the creation of the Financial Services Regulation Committee in your Lordship's House, which I currently chair. Now, Clause 17 not only excuses the regulators from having regard to the regulatory principles, but also repeals the need for the regulators to explain to the parliamentary committees how the regulatory principles apply to their draft regulations. This is a naked attempt to neutralise the work of the select committees of Parliament in holding the regulators to account. Now, the FSMA model is a bureaucrats and politicians' dream come true. The Treasury can always point to the regulators if something goes wrong, and the regulators are largely unaccountable. We must use this bill to make the accountability of the regulators stronger, not as currently weaker. My Lords, there will be much to discuss in committee.
My Lords, it's a pleasure to take part in this second reading of the Financial Services and Markets Bill and to follow the remarks of Baroness Noakes. In doing so, I declare my interest as Chair of Norton Rose Fulbright, a law firm. I'd like to start by thanking my noble friend the Minister for his comprehensive introduction to this bill. The bill contains an important balance of protections for consumers, from widening the scope of the Common Bond for credit unions to ensuring access to in-person banking services, while responding to the needs of the financial services industry. As your Lordships know, the financial services sector is important to the nation, both domestically and globally. It provides well-paid jobs across the country and supports our international standing, since the UK is the largest net exporter of financial services. It's therefore important that we have a regulatory regime which is agile and proportionate. Many of us believe that the current burden of regulation is too high, with delays and costs affecting both growth and competitiveness. The bill implements measures that the financial services industry has been calling for. I particularly welcome the changes to the senior managers and certification regime, as it will reduce administrative burdens on business and allow it to operate more efficiently. I'm very glad to see the repeal of the conduct rules proposed in Clause 35, which are heavy-handed and don't reflect the approach adopted by many of our competitor markets. The changes to the senior managers regime will hopefully address the absurd situation I have seen of senior people running their firms in EU capitals, moving to London and having to wait many months before they're able to perform the same role in London pending FCA approval. Similarly, the temporary permission regime under Part 4A of FSMA is a welcome and pragmatic regulatory innovation that allows start-up and early-stage businesses to conduct regulated activities while they meet the threshold conditions. It's been nearly 2 decades since the global financial crisis, and it is right that the bill is updating the statutory framework underpinning ring fencing to reflect the reality that banks are much better capitalised now compared to 2008, and we also have the resolution framework. Today, there are greater concerns about the systemic risk created by the growth of private credit and the valuations underlying it than concerns about retail banks. An indication of how much the broader financial marketplace has changed since 2008 and where consumers may be exposed is suggested by the FCA's research in 2024, which found that 7 million UK adults, that was 12% of the population, owned crypto assets, compared to just 9.3 million, 17%, who owned a stocks and shares ISA. We can't keep looking back when the world before us is so radically different. There is much else in the bill which is to be applauded, including the Financial Ombudsman service reforms and the abolition of the Payment Systems Regulator, with the transfer of its functions to the FCA. That has been welcomed by the PSR itself as a pragmatic next step in simplifying and clarifying payments regulations, and it is a rare example of reducing the number of regulators rather than merely increasing them. However, I'd like to indicate 3 areas where I would suggest enhanced scrutiny as the bill is considered in more detail. Firstly, and I really hesitate to disagree with my noble friend Baroness Hodge of Barking, who highlights the scourge of economic crime, but I'm not at all persuaded that Clause 14 will have the desired effect that she is looking for, by giving the FCA supervisory responsibilities for anti-money laundering and counter-terrorist financing for professional services. I can see why the Treasury thinks it would be tidier for the FCA to be the single supervisor in the place of 22 professional supervisory bodies, but if I apply this to law firms which are currently supervised by the Solicitor's Regulatory Authority, and that is a regulator and not an advocacy body, the outcome will be that we will simply have another regulator in addition to the 15 we currently have to answer to, and one which has no experience of supervising professional services firms, let alone law firms. I can assure your Lordships that solicitors are not currently an under-regulated profession, and it is not a lack of regulation which contributes to financial crime. Might I suggest that where crimes are being committed, that the law is enforced, and where schemes exist that are not currently illegal, they are made so. The fact that the FCA has no experience of professional services firms and will need to develop its expertise is reflected in clause 48 of the bill, which provides for additional funding for the FCA exceeding £2.7 million a year for more than 2 years to, and I quote, cover costs incurred as a result of the preparatory work for the expansion of the FCA's AML-CTF supervisory responsibilities. May I suggest that we use this money instead to support legal aid, which is sorely needed. Professional services firms are part of the ecosystem which makes the city so successful, and the likely lack of clarity which may persist for some time as the FCA takes responsibility for a sector it is unfamiliar with is likely to add to both increased compliance costs and delay, which the bill is seeking to diminish. I know the Law Society is extremely concerned about this proposal and has raised important issues as to how legal professional privilege, client confidentiality and duties to the court will be protected, which will need to be addressed if Clause 14 is to apply to law firms. Secondly, I'm concerned about the extent to which Henry VIII powers are relied on in the bill generally, and suggest that we look carefully at the extent to which this is necessary in each case. One of the biggest concerns of business will be uncertainty while we wait for clarity as to what new provisions will be introduced, and there are, of course, broader concerns about parliamentary oversight with which I have sympathy. I understand that regulation needs to be agile in a fast-changing world, and see the necessity, for example, in clauses 46 and 47 of introducing a broad power allowing the seizure and forfeiture regime to evolve as technology and language develops to prevent criminals from using crypto assets for illicit purposes, but I query whether this approach is needed in every case in which it is being proposed. Finally, I believe there will also be concerns about whether the FCA has the capacity to take on all these additional roles and responsibilities at a time when it is under pressure to respond to the second competitiveness objective. I note that the FCA is receiving extra funding for taking on AML-CTF responsibilities for professional services firms, but I haven't seen additional funding for the many other duties that the bill will transfer to it. As we've seen from a number of reports, not least from the Growing Pains report produced by the Financial Services Regulation Committee that has already been referred to, and the No Time to Lose report produced by PwC, there is a strong sense in our professional and services sector that it is currently over-regulated and subject to compliance costs and delays which negatively impact its competitiveness. This bill makes a start in addressing those concerns, so I welcome it and I look forward to engaging constructively in the debate as it progresses through your Lordship's House.
My Lords, unlike many noble lords who will contribute to today's debate, I have no direct experience of working in the financial services sector, although I suspect I might even apply for associate membership of the Noble Baroness Noakes club of members of your Lordship House who take part in this legislation. And like pretty well everyone else in the country, I've had experience, not always happy experience, of being a customer of the financial services industry, sometimes because of my status as a politically exposed person, which seems to bleed into my daughters-in-law and all sorts of people, and sometimes simply wrestling with the challenges of communication and relationships with banks, insurers, and others. But I do have experience as a regulator, not in this area, but in relation to health, initially decades ago in the approval of clinical trials, then in the setting up of the Human Tissue Authority, which I chaired. I sat on the Human Fertilisation and Embryo Authority and was for 6 years a member of the General Medical Council. Those experiences have made me a firm believer that clear, effective and proportionate regulation can not only protect patients and consumers, but can also protect those who deliver those services and who are committed to their growth and their success. This bill gives us the opportunity to take stock of whether the current frameworks are both protecting consumers and properly supporting the smooth functioning of our financial services industry, ensuring that it will remain attractive and able to continue growing and contributing positively well into the future. So it will be a matter of finding the correct balance, as it so often is on so many issues in your Lordship's House. The area that I want to explore today is the sector's ability to prepare and respond to the systemic impacts of climate change and nature loss. We took a similar approach in the last Financial Services and Markets Act 2023, which introduced important regulatory principles that aligned governance of the UK financial services sector with the UK's climate and environmental goals. The challenges these provisions sought to address do not follow national borders, and the threats they pose are no longer distant or hypothetical concerns, but are impacting actors within the financial system now. The Climate Change Committee and the Bank of England both warn that these types of risks can have tipping points, which could have serious implications for the UK's financial stability, our ability to avoid or manage sudden shocks to the market, and long-term economic resilience. Some aspects of the financial ecosystem are particularly vulnerable. For instance, we're already seeing the effects of drought, of flooding, of coastal erosion from sea level rises, and extreme weather on the insurance markets. And we have seen the problems that arise out of that in terms of mortgage lending, affordability for homeowners, as well as to infrastructure and supply chains both in the UK and globally. According to the Swiss Re Institute, the global, quotes, protection gap, unquotes, between insured and uninsured losses from natural catastrophes rose to an estimated $424 billion in 2025, up $29 billion from 2024, with wildfires and flooding accounting for more than 50% of the increase. And, however, there is anxiety that within the Bill's objectives to drive growth, increase competition and innovation for financial services, the new system proposed does not account for the risks faced right now, and the solutions to adapt to them, which are then not put in place, have the potential to undermine the government's goals. One area where progress is urgently needed is on the government's stated intention to deliver its manifesto pledge to mandate UK-related financial institutions, including banks, pension funds, insurers, and FTSE 100 companies, to develop and implement transition plans in line with the Paris Agreement. There was a consultation last summer, but we haven't seen any plans and can ill afford for there to be further delayed. The Task Force on Nature-Related Financial Disclosures, a global voluntary framework designed to help businesses and financial institutions assess, report and act on their nature dependencies and impacts, also remains only voluntary, and in contrast to the requirements for some funds under the Task Force on Climate-Related Disclosure, so it would be helpful to understand what steps the government is taking to expand coverage and adoption of the TNFD. And then, of course, there is the concern raised by the Noble Baroness Lady Noakes that it appears that the FCA and PRA will no longer be required to have regard to some of their regulatory principles, which include climate, environment and obligations, in their day-to-day functioning, and will instead be asked to set out how they are adhering to them in strategy documents. There is a concern that this could water down a useful and necessary steer at a point where we need to be asking regulators to do all they can to safeguard financial services preparedness to deal with and adapt to climate change. So I will look forward to debating Clause 17 in some detail. Finally, I and many others were encouraged by the Government's previous commitment to bring forward statutory guidance that will offer pension schemes clarity as to how they consider investments for savers in relation to systemic risks like climate change. I would be grateful if the Minister can reassure me that schemes will not have to wait too long to see details as to when and how these plans will be brought forward. I close by stressing that this bill is about making sure the financial sector is able to capitalise on all the economic and investment opportunities at hand, and that includes adapting to the impacts of climate change, which are already being felt.
My Lords, my background profession before I joined the House of Lords was as a finance practitioner, and I still work pro bono with consumer organisations, some of which have a view on this bill. But I think most relevant for what I'm going to say, I am a fellow at Cambridge University where I teach a course which is focused on how we create a purposeful finance industry, one which, like all good market institutions, prospers when it serves the outside world. And I think to help build such a purposeful industry should be the goal of this legislation, because it's a profoundly important goal, partly because of what Noble Baroness Neville Rolfe said. This is the jewel in our economic crown in the UK. But, you know, it's more than that. We need a successful finance industry if we're going to be able to solve the really critical problems of the country and the world. Growth, prosperity, looking after people in old age, thinking how we address, as Baroness Hayman was saying, the growing climate challenge. And look, there is no successful finance industry without effective regulation. And as the House of Lords Committee on Financial Regulation has noted, we don't have a blueprint for what the best regulation looks like. And we've made big mistakes in the past. The global financial crisis took place despite the regulation that was there. Some might even argue in some ways because of the nature of the regulation. And so I just wondered whether, as a whole House, we might agree on a starting point. That is, we are trying to get a finance industry which will fulfill its purpose well in serving the outside world. That means keeping our money safe, it means helping us to transact, it means allowing us to share risk, and critically allowing us to take our money from point A where it is to point B where it's needed and can create growth and prosperity. But for that to happen, we need an industry that is trustworthy and trusted to carry out these purposes. Otherwise, people won't save and people will not borrow. So that all seems pretty straightforward, but there is a problem, which I think we should recognise. You know, people don't express that they trust the finance industry. According to FCA surveys in 1924, 36% of people, only 36%, felt that most financial firms are honest and transparent in the way that they're treated. 27% felt exactly the opposite of that. Some years ago, you know, the Bank of England asked British people to find one word to describe the finance industry. Do you know what word they chose? It was corrupt. The finance industry is about 8% from the Noble Lord the Minister, or 12% from the opposition bench, or 9%, but 9% of the GDP of the UK. It's responsible for 42% of corporate fines that have been issued. The local government ombudsman gets 22,000 complaints each year. The financial ombudsman gets 216,000. I could go on, but this is an issue that needs solved. And I think it's not the most concerning issue. Malfeasance is not the most concerning issue. I think it's about productivity. Because on the best academic evidence that we have, there is little evidence that the cost of getting money from point A to point B has fallen by very much, even over a period of 100 years. No other major industry has such a poor record in productivity terms over such a period of time. And at the same time, 1.3 million British people don't have a bank account. British bank lending, according to the FT a couple of weeks ago to SMEs, is the lowest percentage of GDP than it has been this century. So big gaps also in what our financial system is doing. And these problems occur despite, or maybe even because of, the regulation, the lot and lot of regulation we've got. Robin Ellison is a partner in one of the big law firms, now retired, a pensions partner. He reckoned in 1990 we had 3,000 pages of regulation of pensions. A couple of years back, it had risen to 165, from 3,000 to 165,000. And we must be sure that we're not encouraging a world where finance practitioners are spending their time thinking about how it is that they get round the regulation. You know, it's euphemistically called regulatory arbitrage. And what happens is it creates a game of whack-a-mole, where there's a rule, someone finds a way around, we whack that rule, someone finds a way around, and we end up with a burdensome and expanding rule book. As the noble Lord Eatwell said, we need a new settlement. But in that settlement, regulation is just one piece of the ecosystem. There are also institutions and markets and incentives and ethics and professionalism and technologies, all of which are changing rapidly day to day. So getting the regulation right means it needs to fit into this much larger system. So that I would have as a background, and I hope a background on which we might agree. And I think it has implications. If I was just to turn to the bill itself, look, first of all, I'd applaud many parts of this bill. For example, the encouragement of credit unions and thinking about how it is that we can get credit to people who need that fairly. But one concern might be, and it might be helpful to clarify, that as we change the rules by which the Financial Ombudsman Service adjudicates, that we need, as the noble Lord Burns said, to keep these principles based. Why is that? Because these are dynamic markets and we're trying to minimize regulatory arbitrage. And maybe that could be made clear just from the outset, that when reference is made to the Financial Ombudsman Service only adjudicating on breaches of the FCA rules, that these rules include the principles of business and the code of conduct. Look, there are many other comments that one might make, but I think they are best addressed in committee. For now, really, my key points would be these. First, that in any effective market economy, success should be contingent on serving customers well. There's a deficit of trust for the financial services industry, and regulation that should be there to align consumer, producer, and society. But my broader point for this House would be that it might be helpful in debating this bill if we can express a consensus shared with industry, shared with consumer groups, that we want a finance industry that is there effectively to fulfil its proper purposes to the world. I look forward to our coming discussions. Thank you.
First, I better declare my interests as a director of Vloop Impact Captive. This bill is a chunky addition to the impenetrable forest of financial services legislation, relocating key issues into the even larger forest of regulator rules. And I ask, who is it for? It can't only be for business, it must also be for people, and that is how I will interrogate the bill. How are people affected when primary legislation is repealed and their rights transferred to regulators? How will they feel when their MP says it's out of the hands of Parliament, in fact often out of the hands of Treasury and out of the hands of the courts? because that's what clauses 1 and 17 do. Fair for people means anchored in law, not left to discretion, not left to drift, not left to 5-year strategies, which warns that the bill removes vital protections without clarity on how or if they will be replaced. And uncertainty for people is also uncertainty for business. And while I understand well the pressures on firms and regulators to achieve more certainty over long-tail risks, that cannot justify Parliament removing statutory rights before we know what will replace them. Now, I do share the aim for growth, investment and competitiveness, but growth cannot be built on taking advantage of people. Stripping primary legislation of fundamental protections, both rights and remedies, replacing them with yet-to-be-seen secondary legislation, and removing Parliament from its past and future influence is not the route to stable, responsible growth. 3 areas illustrate this: consumer credit, access to banking, and the removal of the have regards. On consumer credit, the unfair relationship provisions, Section 75, unenforceability rules and protections for vulnerable borrowers are core statutory rights and remedies, not conveniences. The FCA's conflicting provisions on motor finance, where they originally said there was no need to disclose commission arrangements unless asked, shows that the legislative line set by Parliament was not followed. They didn't get that right. Will they get it right in future? So before the Consumer Credit Act is hollowed out, will the government define in this bill a core of statutory protections, the rights and the associated remedies that make those rights effective, that will remain in primary legislation? Turning to Clause 3 on access to banking, this raises a fundamental question about the balance between consultation, ministerial discretion and parliamentary scrutiny. The government wants to consult on access to banking services and then implement the outcome through regulations that amend primary legislation, and including with FCA rules as they change over time. Parliament's role becomes a take-it-or-leave-it vote on an unamendable instrument. Clause 3 could be more tightly framed, for example, linking it expressly to matters already consulted on, or by avoiding automatic changes to the law when FCA rules are updated. Access to banking is vital. Members of the other place will not want to tell their constituents, we have no influence. My Lords, the consistent pattern is that this government wants to do without Parliament in future and eradicate its past. And the next eradication of Parliament's voice is the removal of the have regards, the principles that anchor regulators to law, proportionality and Parliament's intent. In practice, regulators trivialised them. Then in their consultation response, said these duties were burdensome, and the government did their bidding, removing them from operational decision-making and, fundamentally, the basis on which courts can test that delivery. Administrative inconvenience is not a constitutional principle, and if the issue is frequent or laboured reasoning, that can be solved without removing the duties. British Steel pensions showed why the have regards must stay. The FCA had full perimeter responsibility, yet the principles, vulnerability, transparency, proportionality, were treated as a box-ticking exercise. Parliament had to drag the issue into the open before the regulator acted. The answer is not to remove the principles on which we were able to drag, but to insist that they are applied properly. Dame Elizabeth Gloucester's report into LCF found the same pattern. The FCA failed to apply the statutory principles Parliament had set, treated them as peripheral, and did not understand the framework in which they were meant to operate. Their response? Mechanistic have-regards tables, which was defensive paperwork, not culture change. If anything, that shows why these duties must remain in law, be effective, and not be removed at the regulator's request. And before anybody says the consumer duty does it all, it doesn't. It doesn't replace statutory duties. It doesn't bind the regulator in any way that Parliament can. And it certainly doesn't give courts the tools they need to test regulatory decisions. It is an FCA rule, changeable by them, not a fair substitute for a statutory duty. Proportionality, transparency and respect for the size and nature of firms must apply to regulators' rulemaking and operational decisions, not pushed to high-level strategy with no legal bite. And the same is very much true for addressing climate change. And this is not just the view of consumer groups. The City UK warns that clauses 16 to 18 weaken Parliament's ability to hold regulators to account. The London Market Group is equally clear that downgrading proportionality is a step backwards. When consumer groups and industry and parliamentarians all say the same thing, the government should listen. I don't know how Treasury has been suckered into suggesting that this is merely administrative, but I'm not buying it. These are protections for people, the fiduciary bargain. So to conclude, this bill has ambition, but it removes safeguards, hands too much to regulators, disenfranchises Parliament, and leaves people without rights and without the remedies that make those rights enforceable and effective, grounded in law. That same uncertainty hurts responsible business, and I'll submit amendments on which I hope we can work together.
There's a thought experiment, more than a century old, that I think should be made compulsory for every financial regulator, every market reformer, and frankly, every politician who has uttered the word modernisation. It comes from G.K. Chesterton, writing in 1929. He's writing about why he was a Catholic, but he makes a critical point that applies more generally. Imagine you come across a fence in the road and cannot immediately see why it is there. The temptation, the modern, progressive, efficient temptation, is to conclude that because you cannot see the purpose, there is no purpose, and to tear it down. Chesterton's counterpoint is simple and devastating. Don't touch it until you understand why it was put there. Because someone at some point thought hard enough about this road to put a fence on it. Only when you know why are you entitled to remove it. This is Chesterton's fence, and I hope people will understand its relevance to this bill. The timeline of financial markets is littered with the wreckage where it was decided that a fence was no longer required. We have experienced a cycle of financial disaster, followed by stronger regulation, followed by the growth of complacency, followed by demands to remove restrictions on markets, followed by injudicious deregulation, followed by yet another disaster. We are seeing this playing out in real time, with, appropriately enough, ring fencing. After 2008, the Vickers Commission recommended that retail banking be ring-fenced from investment banking, rebuilding in modified form something close to the fence that had existed back before Big Bang in 1986. But within a decade, within living memory, pressure has built to weaken the rule. The fence looked costly and complicated. The arguments are familiar. The fence is inefficient. The other jurisdictions don't have it, affecting our competitive position, which puts London at a disadvantage. These are precisely the arguments that preceded the events of 2008. The fence was built because we had just watched what happens without it. Now we have this bill. And the government, I'm pleased to see, is not unaware of the need to maintain consumer protection. The explanatory memorandum states the need to make changes, quote, without compromising on core consumer prudential and market protections. It also states the aim, again quoting, ensuring that consumers continue to access to effective redress. And I thank my noble friend the Minister for his clear statement in introducing this bill in reply to questions raised by myself and other members that consumer rights will be protected. Nevertheless, whilst I trust my noble friend, our aim during the passage of the bill will be to verify that these aims are achieved. We must all be concerned, therefore, that not everything in this bill has been welcomed by organisations representing consumers, not least the Consumers Association itself. So, given its record of defending consumer rights, it is worth highlighting some of its concerns. First, there are the changes to the Financial Ombudsman Service that will restrict consumers' access to timely redress. To my mind, the proposals too closely mirror what the industry has proposed without providing the adequate supporting evidence to move in that direction. The Treasury's own assessment of the FOS is that it functions well in the majority of cases. This is a poor basis for such a fundamental reform. Secondly, the Consumers Association has concerns that the bill removes enforcement sanctions under the Consumer Credit Act 1974 without introducing equivalent replacements and shift other protections from statute into Financial Conduct Authority rules, which we have not yet seen received any consultation. A third problem is the new 10-year time limit on FOS complaints. It's totally unsuited to financial products, large proportion of which are long-term, typical of mortgages, life insurance and pensions. Now, the Consumers Association concerns are far from trivial and will have to be addressed at committee, and I look forward to the debates. Now, the government have been clear that the legislation is driven by an economic argument to foster growth in our world-leading financial sector. But there is also a compelling case made clearly by my noble friend, Lord Pitt Watson, that the effective consumer protection has an economic rationale as well. It's a sector that requires consumer confidence and trust. Financial services are unlike other markets. Products are complex, time horizons are long, and the information gap between the provider and the consumer is substantial. In those circumstances, consumer protection is not an impediment to a well-functioning market. It is a key to that market functioning properly. Remove the fence without checking why it is there, and the likely result is not greater efficiency, but the familiar cycle of mis-selling, scandal, and declining consumer engagement with the very products that we are supposed to serve, products that are supposed to serve their financial interests. A reform agenda framed around growth should therefore be cautious about weakening conditions that make sustainable growth in financial services possible.
My Lords, can I begin by thanking the Noble Lord the Minister for his recent letter, the meeting he convened last week, but also for clearly laying out the ambitions for this Financial Services Bill. For many years, I sat on the Economic and Monetary Affairs Committee of the European Parliament and worked closely with Noble A. Baroness Bowles. I also see Noble A. Baroness Gill when we worked on money market funds together. And on that committee, we scrutinised a slew of regulation following the 2007 to 2008 financial crisis. In each case, I asked 4 questions. Firstly, do we need this legislation? Given how much regulation we already have, what problem is it that we are trying to solve? Or are we just regulating to be seen to be doing something? Secondly, if a bank or other financial institution failed tomorrow, how do we make sure it would not be bailed out with taxpayers' money? Thirdly, who takes responsibility for failure? We debated the merits of a director liability and if this would encourage directors to take more interest in what is on their bank's balance sheets. And fourthly, how do we make sure that when it comes to complex financial instruments on balance sheets, that while banks might be willing to book the income up front, they make sufficient provision for potential losses, just as we saw with the financial instruments like CDOs and CDSs in the run-up to the financial crisis. My Lords, as others have said, it is nearly 20 years since the last crisis, but we should remember that after each crisis, there is a temptation to regulate for the last crisis. Then after a while, there are calls to loosen rules, to increase liquidity or access to credit, which in turn raises concerns about whether this could contribute to the next crisis. So with this bill, I welcome the ambition to reduce complexity and inflexibility, to simplify what has become a complicated consumer credit regime, and to streamline regulations and reduce the number of overlapping regulators. But like my noble friend Baroness notes, we remain concerned about regulator accountability. And while I generally support less regulation, I also recognise that when things go wrong, quite often the public expect politicians to do something, just do something. So we should remember why measures such as ring fencing were introduced, or some would argue reintroduced. Now, the explanatory notes to the bill say that the benefits of ring fencing vary across areas and can, quote, give rise to unintended consequences in practice, unquote. And there's also some concern about the impact on the bank resolution regime. So could the Noble Lord the Minister explain what those unintended consequences were, and also the impact of the reforms on the bank resolution regime? Now, on overseas recognition regime, I welcome the government's intention to take a different approach to the EU. During my time in the European Parliament, much of the equivalence was driven more by protectionism than resilience, often limiting choice for investors and consumers. And on accountability, I welcome reforms to the senior managers and certification regime to improve accountability of appointed representatives. But also we'll be looking to understand how proportionate or burdensome this requirement would be. My Lords, I now come to the area of financial services where I maintain a strong interest. And that is, how do we increase access for those that many describe as financially excluded? Now, both the UK and then the EU brought in legislation to force banks to offer basic bank accounts. Now, that may sound reasonable, but in reality, this was forcing banks to offer accounts to customers they didn't particularly want to serve. I do wonder what that means in terms of customer service. But an unintended consequence is that this squeezes out potential competition from non-banks, such as credit unions, who would welcome the ability to serve these customers and grow. So I welcome the government's intention to increase the number of mutuals and cooperatives and to widen the common bond requirement. But I do wonder whether it could go further. And being slightly radical, can I ask the Noble Lord the Minister, has the government looked at the feasibility of abolishing the common bond altogether? And if so, what concerns were raised? Also, as we see more banking hubs in response to high street bank branch closures, could we perhaps create a win-win situation where credit unions, or CDFIs, which I'll discuss later, actually run those banking hubs? Not only can they serve their customers, but they can earn additional revenue from facilitating payments into or withdrawal from accounts held with banks. And my Lords, I am disappointed not to see an explicit reference to microfinance, what in the UK we call Community Development Financial Institutions, or CDFIs, non-profit, community-based organisations that offer financial support and credit to individuals and financially excluded entrepreneurs who otherwise might turn to payday lenders. Now, one of the most amazing CDFIs, and one I try to help where I can, is Purple Shoots. Founded by Karen Davis, who when she worked in financial services in London, realised that entrepreneurs from poorer backgrounds were often being turned down, not due to their poor business case, but because of their credit status. So she set up Purple Shoots to offer mentoring and loans of between £500 and £3,000. And when it turned down a loan, but thought that the idea had merit, it provides wraparound care to get the entrepreneur's business case into a position where it merits a loan. And the impact has been amazing. When I hosted a parliamentary event for Purple Shoots, we heard from Trevor Palmer, who turned up in a complicated electric wheelchair, and partly for this had been written off by mainstream finance. Now, thanks to advice and a loan from Purple Shoots, he was able to start his enterprise, take himself off benefits, and later employ others and take them off benefits. So organisations like Purple Shoots are driven by both a belief in the spirit of enterprise, but also a real social purpose. As Sam Rex Edwards and Kay Poley from the Financial Innovation Lab said to me, talent, ambition and entrepreneurial potential are spread across the country. Access to finance is not. And while many larger organisations are able to access lottery funding, which in turn means that they can offer much larger loans, Purple Shoots cannot access these funds to offer much smaller loans, but often with a higher social impact. And when they applied for lottery funding, they were told to raise their interest rates and effectively to lend to less entrepreneurs. And while anyone who's unable to pay back on time, quite rightly is counted as a default and is understandable, and that might be understandable for mainstream banks, Purple Shoots instead prefers to give them a little bit more time to repay. For these reasons, it does not tick the right boxes for lottery funding. And while I understand that lottery funding is dealt by another government department, DCMS, could I ask the Noble Lord the Minister, given that the bill does not explicitly mention CDFIs, what is the thinking in both his departments on how to create the space for CDFIs, such as Purple Shoots, to grow and for others to enter the market, to increase access to credit and advice for entrepreneurs from all communities, not from those who have not only those who have easy access to credit. My Lord's time is limited, so I'll end by saying that this bill deserves support, where it reduces needless regulations, but not reduce the accountability of regulators, where it strengthens financial resilience, but does not reduce proportionality, and where it widens financial inclusion, but does not reduce consumer rights.
My Lords, it is truly humbling to hear from so many Lords today with such expertise. As many of you have said, there is much to commend in this legislation. Any measure which will strengthen the financial services in this country is welcome. As was laid out in the Leeds reforms last year, every encouragement should be given to banks or individuals who want to invest in the United Kingdom. The ambitions of the Scottish financial service industry, a hugely important employer in Scotland, in fact the biggest, chimes with the government's ambitions. It's incredibly important, and it hopes the new legislation will shake up the planning system and reduce red tape for investors. In this legislation, amongst other measures, emphasis is put on the government's support for lending and investment. Hopefully, the reforms will unlock more finance for UK businesses, and improved competition in small and medium-sized enterprise lending will help small businesses access finance. I'm not going to talk about regulation. I shall leave it to the experts amongst the noble lords. It is about investment in SMEs, particularly in Scotland, I want to talk about today. Basically, it is not happening as it should, and I'm not exactly sure where this bill will make the difference that's needed. This is a cri de coeur to the Minister. There are entrepreneurial, far-sighted men and women wanting to start a business, to contribute to their communities, to employ people in the communities, and all the time contributing to the UK economy. But there are many obstacles in their way, not least accessing the financial support they often need to confidently take the first steps to create a business. Many areas of Scotland are struggling. Not only are they stranded where Scotland's ferry service doesn't function, but there is not enough housing and too few jobs, and there will be even fewer jobs unless SMEs are able to access investment. Throughout Scotland, businesses are struggling to get investment.
Some of the reasons are given that it's too remote. Perhaps it's time that people in London or Edinburgh think of themselves as remote rather than those who live beyond a metropolis. We know bank lending to British businesses has fallen to its lowest level for many, many years. Perhaps the banks and other lenders did not read the memo from Leeds, but until they change their behaviours, there will be little chance of stronger economic growth. And it may be timely to remind the banks they owe us. Hardly one of them would be standing if it wasn't for the Labour government's Herculean support during the financial crisis of 2008. When bank lending fails, SMEs are disproportionately affected, and banks have pivoted away from SME lending because it can be riskier and less profitable. Banks don't want to invest in startups, they only want to help when business is established, when any risk has been minimised. Surely it's not unreasonable to suggest banks could take more responsibility to invest in the country's most enterprising and entrepreneurial sector. Banks tell you there is no lack of lending capacity, but there is little demand. And it seems many SMEs are less likely to apply for credit for fear of rejection, so it becomes a self-reinforcing loop. One senior figure at a UK bank, quoted in the Financial Times recently, said there was no lack of lending capacity. They said, all the banks are issuing bold lending targets, but if there is no demand, as no one wants to borrow, there isn't a lot we can do. I'd suggest to that senior banker that they should find out what more they can do to get money out of the door. Levels of investment in Scotland are typically lower than the best performing countries in the OECD. In areas such as research and development, investment has been chronically low in comparison with the OECD and below the UK average. And yet Scottish University's contribution to R&D is amongst the best in the OECD countries. SMEs form the backbone of the Scottish economy. There are 350,000 of these important companies employing over 1.3 million people. They are hugely important in farming, retail, hospitality, increasingly in life sciences and space technology. There's great innovation in AI, digital assets and tokenisation in Scotland, but these modern-day pioneers need investment. According to the business sector, they are underserved, and if they're ever going to scale up and contribute meaningfully to our economy and the funding of public services, that needs to change. Too often, startups have had to leave Scotland to seek investment, since investment banks, venture capital and private equity no longer have offices in Scotland. The investment community is very heavily centred in London. That is a pity and a blow to the Scottish economy as it is to other parts of the UK outside the southeast of England. It is important Scottish firms connect with London-based investors and that those investors visit Scotland to properly understand its vast potential. And there are huge opportunities if only they knew about them. Nobody wants to undermine London's economy, but it is a waste of potential if investment horizons in the UK remain so limited. There is confusion about the responsibilities of the UK and Scottish governments. There is a suspicion that too many UK civil servants think Scotland's machinery is completely separate from the UK's. That needs to be cleared up. The City of London joined forces with Number 11 to set up a single investment portal for the UK, which allows all potential investors to see what opportunities there are. Unfortunately, there's been little take-up in Scotland, and it may be that politics are getting in the way. While business north of the border thinks Scottish civil servants may be too sceptical about anything that comes from London. So I would appeal to both governments to work more closely together to take advantage of any facility that might help. In conclusion, I have 4 specific asks for the UK government, which I hope they can consider in this legislation. Please set out a clear vision and structure for accessing funds to grow businesses. Please fly the flag for the whole of the UK when it's talking to overseas investors. Please encourage banks to be more courageous and take risks. And lastly, please tell investors to think beyond London and go to other places from time to time. They will find opportunities. If the government can embrace these asks, I'm sure this bill will feel ever more relevant.
Privilege to speak in a debate with those who have such deep understanding of financial services and markets, including a minister with transformational business experience, which we all respect. My own experience as a lawyer has been largely limited in this area to providing unwelcome and pessimistic advice in relation to large frauds, some of which have enriched the egregious fraudster to an extent that he, and it's usually a he, has gone on to lead a very successful financial life. This is not good for the reputation of the financial services industry. And in that context, I would just remind your lordships of something that my profession, the legal profession, does rather successfully and in an increasing amount as part of the informal part of financial regulation. And that is the increase in private prosecutions which are used to bring fraudsters to justice. And I would just remind your lordships who are interested in this rather narrow subject of the successful prosecution in 2018 in what is called the Allseas case, in which the Director of Public Prosecutions at the time had twice refused to prosecute, but the private prosecution was successful. But to turn to the generality of this very interesting bill, I would say to your lordships that financial markets are living instruments in the most literal meaning of that phrase. And when we legislate, there is an imperative to provide flexibility to meet need rather than waiting for reactive new legislation when something has to be done because it's gone wrong. So this is a very important legislative opportunity in which we have a duty to enact the new law with due anticipation of potential unpredictability, a difficult but important task. Intrinsic to this bill, my lords, is the relationship between Parliament, regulators and the citizen. Over recent decades, we've witnessed a significant shift in the way financial services are regulated. Increasingly, Parliament has established broad frameworks while regulators are entrusted with responsibility for detailed implementation. There are understandable reasons for this, and in this area, although I'm rather against regulations rather than a main act provision, I think there is room for quite a lot of regulation so that that living instrument can survive. For my lords, technological innovation proceeds at extraordinary speed. Parliament can enable. The regulators are there to provide expertise and experience which uses the statutory foundation to enable proportionate reaction to whatever future challenges may arise. I turn now, my lords, to three specifics. First, Clause 7 in Part 2 of the bill reforms the Financial Ombudsman Service. I support those changes in the round, but I do urge on the government that thought should be given to enhancing them so that entities themselves have the ability to request a referral to the Financial Conduct Authority for advice on rule interpretation rather than leaving it to the Financial Ombudsman Service on a case-by-case service. Important principles can arise and it should not take so long to resolve them. Secondly, I would urge additional attention to authorised push payment fraud. This is a major and egregious fraud to consumers, costing about £450 million in losses annually, mostly to unsophisticated people. I hope that this bill can be amended to strengthen safeguards to prevent that kind of fraud at source, specifically by requiring online marketplaces to apply Know Your Customer checks to sellers and also on-platform traceable payment methods to defeat the cruelty of fraudsters. Thirdly, I want to mention the important issue of collective actions. Collective actions are funded by litigation funders who are now part of financial services and are recognised as such. I have played some part in collective actions and still do. Sometimes they may involve a dozen claimants. Sometimes they involve 10,000 claimants. These are collective actions that give the opportunity for ordinary people to recover damages for frauds committed upon them, some by the financial sector, I'm afraid, which they would not otherwise be able to recover from. litigation funding inadvertently has been very damaged by a Supreme Court case called the Packard case. Legislation was introduced in the last Parliament with the agreement of both main parties, indeed all three main parties, to push it through quickly. But the election came and that was not done. And I and other noble lords are happy to discuss with the Minister the Packard situation in the hope that it could be dealt with in this bill, in which I believe it is in scope. But returning to more general matters, my Lord, Parliament should never lose sight of the distinction between creating rights and administering those rights. The House must therefore carefully examine any provisions that may have the effect of transferring important questions of consumer protection from primary statute into a wood which we cannot see through for the trees. My Lords, I illustrate this concern through the issue of consumer redress. One of the recurring themes in modern financial services regulation has been the recognition that consumers require effective mechanisms through which to enforce their rights. I've been waiting years to say this, my Lords, but a right without an effective remedy qualifies what the eminent jurist Hofelt strikingly described as a no right. This bill should avoid no rights.
My Lords, it's a great pleasure to follow such a thoughtful speech from the noble Lord, Lord Carlisle, who has picked up on a couple of points that I was going to mention. Firstly, I should draw the House attention to my interests as a non-executive director at Santander UK, a non-executive director at the Financial Services Compensation Scheme, which oversees consumer redress, and also as chair of the Advertising Standards Authority, which is a regulator. Because of those interests, I don't normally talk about financial services in this House, but because this is a more general debate at the start of the legislation, I wanted to hopefully assist with a couple of factual points and then to pick up on some two areas of policy on which I think the bill is currently silent, and the noble Lord Carlisle has just picked up on one of them. I don't intend to take part in further stages, except possibly, depending on the noble Lord the Minister's answer on the final policy issue I raise, I might return to that. Let me start with ring-fencing reform, and we've already heard from a number of noble lords as to why reforms were introduced. Just to keep this onto a factual basis, or to give an example of Lord Kamal's unintended consequences, there are two examples I want to give of why ring-fencing is something that can be unhelpful to consumers and in the case of economic growth. So for a travel company, for example, offering package trips who wanted to mitigate its exposure to increased fuel costs and foreign exchange costs, it wanted to take options on forward fuel FX costs, they cannot be offered within the ring-fence bank, which they bank with. That can be obtained from another financial institution, but obviously it means extra costs and takes longer, which means that consumers ultimately will pay those costs. Or for a UK energy company looking for investment, the ring-fence rules as currently drafted meant that lending to the holding company was not permitted, so lending had to be to a subsidiary on a strict reading of the rules. Is that really what was intended? Are we serious about bringing down the cost of doing business in a sector, energy, which has very real resonance for households as well as a link to national energy security? Moving to the Financial Ombudsman Service and reform, I appreciate the significant strength, and we've heard in the briefings to noble lords the strength of feeling amongst consumer groups on these proposed reforms. I would just say two things here. Firstly, that predictability of law and regulation is an important principle of doing business in the United Kingdom and something that businesses want to see. And secondly, so far today, in the speeches I have heard about Financial Ombudsman Service reform, I haven't heard anything said about the actions taken or the way that certain claims management companies' business models are based on bringing cases to the Ombudsman. And I think that the Financial Ombudsman performs an incredibly important role, and financial institutions should be held accountable when they get it wrong for customers. But we shouldn't lose sight of claims management companies making money from customers and those customers do not need to use the services of claims management companies when they are looking for financial redress. Let me turn now to one area which the Ombudsman has had many complaints about and has rightly upheld many of those complaints, and that's the one that the Noble Lord Carlisle mentioned, which is fraud. In November 2022, I had the privilege of overseeing the publication of a House of Lords inquiry report on which is called Fighting Fraud, Breaking the Chain, and in which we said that over 80% of fraud is cyber-enabled. In the year ending June 2025, there were an estimated 4.1 million fraud incidents, according to the Crime Survey for England and Wales. This was a 14% increase compared with the figures for 2024. And out of those 4.1 million incidents, around 3 million involved a loss, and victims said they were fully reimbursed in 2.2 million of those cases. The reason for mentioning it here is the bill is silent, does not contain anything about fraud affecting the financial services sector. And I think the point is just that I hope that the Treasury is not leaving it to the Home Office to lead on this. Fraud is not a victimless crime. As we've already heard, the role of online platforms and marketplaces is very important. Romance fraud is hugely costly, both financially but also personally, to the victims. We've heard debate earlier on about the changes to the senior managers' certification regime. Whilst I understand that, perhaps in this context of the bill, frankly, I would extend the senior manager certification regime to the bosses of the tech companies to make them accountable for what is happening on their platforms. And of course, since 2022, the world has moved on, and the issue of deep fakes in relation to fraud, and today I was hearing about ChatGPT recommending fake websites which are costing their victims huge amounts of money. So I'm sorry that this bill is silent on such an important issue for financial services. Let me move to the final policy area, which I hope that the Noble Lord the Minister might be able to say something about, which relates to economic abuse. This is a devastating form of domestic abuse used by abusive partners or ex-partners to control a victim survivor's money and economic resources, and it includes the routine misuse of financial products and services such as a bank account, a mortgage or credit. 4.2 million UK women experienced economic abuse in the last year alone, leaving them carrying debts coerced in their name, trapped in joint financial products with abusers long after separation, while their credit scores are tarnished by the abuse, leading to immediate and long-term financial exclusion. A staggering 750,000 UK women experienced economic abuse through the joint mortgage that they share with an abusive partner or ex-partner. And perpetrators will routinely use these ties to coerce and control survivors long after separation, leaving their victim survivors facing arrears, repossession, credit destruction, and even homelessness. Now, financial services firms' contractual obligations to both parties through the concept of joint and several liability limits the steps those institutions can take to prevent these harms through joint mortgages, and it's clear that urgent legislative reform is necessary to address this. I welcome the government's financial inclusion and violence against women and girls strategies. Both of them make significant commitments to tackle economic abuse and to ensure consistent responses from financial services to support victim survivors. So can I just ask the Noble Lord, the Minister, how he will, or the government will ensure implementation of the bill effectively supports good outcomes for economic abuse victim survivors as vulnerable customers? And will his department use this bill to remove the legislative barriers that still prevent financial services institutions from safeguarding victim survivors against the harms caused through joint mortgage abuse? I fully agree with the comment that the Noble Lord made at the beginning of this debate, which is this whole bill is a question of balance. And I look forward to hearing how that balance is resolved in the forthcoming debates.
My Lords, the financial services sector, as many have already highlighted, remains an absolute engine of the British economy, contributing £290 billion, or roughly 11% of the total UK economic output, with productivity at 2.6 times the national average. To maintain this competitive edge, our regulatory framework must prioritise nimble execution while reinforcing structural accountability. Therefore, the Financial and Markets Bill is a necessary modernisation of our economic architecture. And like Baroness Hodge, I welcome that this legislation directly addresses critical pressure points in economic crime and market efficiency. Firstly, by combating financial crime, the expansion of FCA oversight across legal and accountancy sectors tackles a severe risk channel. Financial institutions currently spend estimated 38.3 billion annually on financial crime compliance. Unifying oversight directly addresses the structural fragmentation noted by His Majesty's Treasury, where 25 separate supervisors have historically led to inconsistent enforcement across sectors. Secondly, it's protecting the infrastructure. For cash access secures vital banking functions for millions of people who depend on cash and face-to-face banking. Thirdly, it's streamlining regulations, merging the payment systems regulator into the FCA, eliminates costly institutional overlap and accelerates decision-making. I particularly welcome that it's empowering credit unions by reforming the historic common bond. Members' requirement that this bill allows credit unions to sustainably scale up and expand their services. Under the old 1979 limits, these rules became a restrictive postcode lottery. For example, a credit union was banned from growing if the population in its geographic area exceeded 3 million. That's most of London. Relatives who didn't live under the exact same roof were also barred from joining. So by reforming historic constraint, the bill drags these rules into the 21st century by raising the membership cap from 3 to 10 million, allowing credit unions to expand, merge and scale up, and adding students to the local criteria so younger people can access affordable community borrowing, and updating family rules so relatives can join even if they live in different households. As the government states that this bill provides a major boost to affordable community finance and directly supports the national goal to double the size of the mutual and cooperative sector. We've already heard that the bill also modernises the Financial Ombudsman Service, and I believe that disputes will be resolved faster with much greater operational certainty. And the proposal, again, we've heard from various members of your Lordship's House, that will unlock billions of potential lending to small businesses across the country through raising primary deposit thresholds from 25 billion to 35 billion, which would free retail-focused banking groups from overly restrictive ring-fencing rules. Now, majority of financial organisations have welcomed this bill. However, there are some concerns. I've been contacted, like others, by UK Finance, City UK and Parliament's own Treasury Committee have highlighted that clauses 16, 17 and 18 are of concern as the balance of power shifts from necessary democratic checks. It's good to see my friend Lord Kamal in his place, because he and I, as he alluded to, served on the European Parliament's Economic and Monetary Affairs Committee together. And during the major post-crisis reforms, particularly when we were building the single rule book, Econ faced these exact structural pressures. We learnt the hard way that when you delegate sweeping powers to independent regulators, you need to hardwire accountability in their operations. We had to fight to ensure that principles like proportionality weren't pushed into a vague multi-year strategies, but were applied to everyday policy making.
So it is that specific practical experience of balancing regulatory independence with democratic scrutiny that has informed my analysis today. So just referring to some of the clauses, Clause 16, which introduces a statutory requirement for FCA and PRA to introduce long-term strategies at least once every 5 years. Whilst I accept that a long-term roadmap is incredibly useful for business planning, markets move fast. A 5-year plan can easily become outdated if there isn't a required check-in point to adjust the strategy to new economic realities. So could my noble friend, the Minister, clarify how will the government guarantee that the regulators formally consult with the consumer, business and commercial panels during the development phase? Would a review at 3-year mark overcome this to prevent these roadmaps from stagnating if no new remit letters are issued? Now, Clause 17 removes the operational requirement for regulators to consider core statutory principles such as proportionality, transparency and risk-based regulation in their day-to-day functions, moving them exclusively into 5-year strategic loop. However, in March 2025, the Regulation Action Plan explicitly committed to introducing a streamlined consolidated list of heavy regards via secondary legislation. So could the Minister confirm that the government will use secondary legislation to establish a rationalised daily checklist for regulators, ensuring that the day-to-day policy making remains structurally bounded by proportionality? Finally, Clause 18 removes the obligation from regulators to consult on guidance and minor rule changes, while they're lifting requirements to explain how routine standard setting of their core objective. Now, in the financial sector, regulatory guidance serves as de facto rules. Firms alter compliance frameworks and deploy significant capital based on it. So without statutory duty to consult on guidance, what mechanisms will protect market participants from unvetted sudden shifts in the regulatory expectations?
My Lords, may I declare interest as a holder of listed shares and a director of a listed investment trust. There's much to be commended in this proposed legislation. Any reduction in regulation and the consequential benefit on the wealth of the nation is to be applauded. I am, however, concerned about the proposed power which will enable new regulations to be introduced without scrutiny. Although introduced with the best intentions, regulations can do more harm than good, partly recognised by having the bill in front of us today. It is not always possible to foresee the full consequences of regulation. Generally speaking, the more markets are left to themselves, the better off we all are. An example of regulations having a negative effect is the Basel II Agreement. This ruled that personal mortgages were safer than other types of lending, and therefore banks would need a lower capital requirement for lending for house purchases. I won't waste your Lordship's time with the full story, caravans in trailer parks being classed as houses, and so on. But this was ultimately a major contributor to the 2008 financial crisis, brought about by a change in regulations. Because of the crisis, regulation in Great Britain was made for pension funds to invest a higher proportion of their funds into safer gilt-edged securities. The gilts gave a lower return than other types of investment. To compensate, pension funds used their gilt-edged securities as collateral to buy more gilt-edged securities to give an overall larger return. Little risk, as both instruments were government-backed. Unfortunately, it slipped their minds that interest rates can go up as well as down, and rising interest rates would result in losses. Interest rates did go up. Even the Bank of England's own pension fund was caught out as interest rates rose, and its pension fund faced large losses. One regulation on top of another. It is not always possible to see the knock-on effect of regulations. So I urge your lordships, when taking this bill forward, to have clearly in mind the inability of anyone to fully know what benefits or what collateral damage may result from new regulations. Whilst flexibility may be desirable, delegating too much power without the ability for rulemaking bodies to be questioned independently and firmly is very important. It will not do everything, but it may put a brake on rules which impede or hamper the development and success of our financial services industry and reduce risk.
My Lords, I'd like to thank my noble friend the Minister for bringing this bill and for the many important clauses contained therein. And we've had some excellent contributions, but I particularly want to thank the Right Reverend Prelate, the Bishop of Manchester, for his powerful intervention on the nature of debt and its particularly devastating consequences, and to the noble Baroness Morgan of Coates for raising the important issue of financial abuse and how this bill may legislate to be firmly on the side of victim survivors. I wanted to contribute to this debate not because I am an expert in financial services like many eminent speakers from across your Lordship's house today. I wanted to speak in this debate because I care about fairness and the accessibility of financial services to all of those in our society, so that everyone in the country is able to access ethical and affordable finance. I welcome the measures in this bill, and particularly the clauses regarding credit unions and measures to protect face-to-face banking. As a member of the sister party to the Labour Party, the Cooperative Party, I declare an interest, and I was delighted to see in 2024 that Labour manifesto commitment to double the size of the UK's cooperative and mutual sector. And this bill puts legislative meat on the manifesto bones of how we might do that. A financial system should serve the economy, and the economy should serve society. As last year's Triodos Bank report noted, finance has too often become an end in itself, a self-referential network of balance sheets and algorithms more focused on extracting value than creating it. And this Labour government is committed to growth, but not growth at any cost, not extractive slash-and-burn economics, but growth that offers people in every part of the UK the opportunity to flourish. Before I come to the proposed changes to the bill, I want to outline why these measures to increase the use of credit unions are so crucial. As others have said today, as other noble lords have said today, the UK has an affordable credit problem. Between 16 and 20 million people, depending on the source you use, are underserved by the credit market. So that's up to 20 million people in the UK who typically have a credit history that falls outside mainstream underwriting criteria. This is a large, non-standard population with a growing need for credit. They fall into broadly three groups. Those known as thin file, that's people with low or no credit history. The credit impaired, those with a poor credit rating, often this may be linked to disruptive life events, usually temporary, something like moving house repeatedly, divorce, loss of a job, which might lead to missed repayments. And the third group, those who are highly indebted, people who have taken on too much debt and cannot afford to repay it. And these households are facing material economic headwinds, and access to affordable credit is of absolutely crucial importance to ensure both the near-term economic well-being of those people, their families and communities, and also to ensure that the near-term economic conditions do not become entrenched so as to affect the long-term viability of these households and communities as credible borrowers. Outside the realm of personal finance, SMEs and social enterprises also face a multi-billion-pound finance gap, particularly those based outside London and the South East. According to figures from the Federation of Small Business, over half of small businesses rate the overall availability and affordability of new credit as poor. So, those are some of the reasons why I am passionate about credit unions and the increase in their use. As has been said before in this debate, they are member-owned cooperatives with deep ties to local communities who are accountable to their members rather than to shareholders. They provide access to credit for people who may be excluded from high street banks and offer a more relationship-based model of lending, an essential quality of a financial system that works for everyone in society. To illustrate this, I've picked a few thumbnail testimonials from Salford Credit Union. For example, the unemployed parent who was offered a free college course to train as a hairdresser, they couldn't afford the £200 needed to provide the equipment to undertake that course. Salford Credit Union stepped in, loaned them £200, they were able to buy the kit, retrain, and then pay that loan back when employed as a hairdresser. The person with 2 children made homeless due to domestic abuse. They were rehoused by a housing association, quite right too, but that property had no furniture. So they applied for and received a loan of £700 to buy furniture, which they were able to pay back at the reasonable rate of £15 per week. Or take the man who was living in a hostel, whose only income came from selling The Big Issue. He was desperate to move out of that hostel because of the difficult living conditions and the abuse that he suffered. The credit union helped him over a number of months slowly save enough for a deposit, his own deposit, to rent a flat in the private rented sector. He would not have been able to do that without the assistance of Salford Credit Union. I could go on and on. Credit unions are brilliant, but crucially, the proposed reforms to the Common Bond will enable the credit unions to serve that wider membership. And this is an overdue reform and another reminder of how this Labour government is working hard every day to improve things for all citizens nationwide. To support even greater sustainable growth and use of credit unions, I asked my noble friend the Minister to consider also capital reforms to credit unions, for example, enabling access to new forms of investment through them. There is also currently no overarching mechanism to assess how effectively banks are meeting the credit needs of underserved communities, and no mandate for the FCA to drive that change. So again, I asked my noble friend the Minister whether the bill could address this by requiring greater transparency and accountability from mainstream lenders, including that formalising of a referral pathway to credit unions or community development finance institutions where customers have been declined by them. These credit unions and community development finance institutions are often best placed to support people and businesses excluded from mainstream finance. In 2025 alone, community development financial institutions lent over £389 million to small businesses, start-ups and individuals, which launched 5,741 businesses, created over 7,000 jobs and safeguarded over 6,500 jobs. 88% of those business customers had been previously declined by another lender. And with CDFIs lending disproportionately to ethnic minority-led businesses, women-led businesses, and businesses based in areas of high deprivation, demonstrating their growing contribution to inclusive economic growth and local resilience, I would ask my noble friend the Minister to look again at these and how they might be used more. Credit unions are growing and an increasingly important part of the UK's community financial infrastructure, providing affordable lending, savings and financial resilience to millions of people. So let us, noble lords, make the most of the opportunity presented by this legislation to turbocharge the potential of credit unions. Finance is not an abstract mechanism, it is a social relationship built on trust shared expectations and collective institutions. A common bond indeed, at a time when we are in need more and more of vehicles for all types of common bond, not just the kind found in a credit union, to be spread more widely and used wherever they can be.
My Lords, can I declare my environmental interests as listed in the register? And can I thank the Minister for his engaging introduction? He obviously knows something about this, and I look forward to discussing amendments with him during the committee stage. Because I want to draw the Minister and the House's attention not to the specific things that are in the bill, but to the specific things that are not in the bill. And I would ask the Noble Lord, the Noble Lord, I think, very adequately outlined how important the UK is as a financial centre. It's home to the biggest share of international bank lending and borrowing. It's big in insurance, it's big in pensions. It's developed a reputation also for being big in sustainable finance. And I think that UK financial services have major further potential to accelerate the transition to a climate and nature positive economy and to unlock green growth. And that's what I would like to focus on today. So it's disappointing a bit that this bill doesn't move that agenda forward. And I do think the short title actually gives a bit of wiggle room to get some good stuff in. One of the government's stated goals is to make the UK the green finance capital of the world. So I don't think I'm trying to press for something that hasn't already been endorsed by government. I'm simply lending a helping hand to get us on the road and to make sure that this bill isn't a missed opportunity. Let me just give you two brief examples and one more substantial one of the issues this bill could have tackled. First of all, the 2024 manifesto on the financial services growth strategy said the government intended to mandate UK regulated financial institutions, that includes the banks, the pension funds, the insurers and FTSE 100 companies, to develop and implement transition plans in line with the 1.5 degree centigrade Paris Agreement goal. Now, these plans would state how each of these institutions would reduce emissions, reshape investments and business activities and manage climate-related risks. And the government consulted in 2025 on taking forward these requirements, but since then there's been silence. This bill could have introduced legislative action on mandation. I'd like to press for that. The second example is that the bill could have made progress on mandating nature-related disclosures. The Institute and Faculty of Actuaries warn that too many financial institutions insufficiently account for climate and nature-related risks in their decision-making and risk management. And I think that the insurance industry is very rapidly waking up to those impacts. Reporting on climate-related financial disclosures, TCFD, is mandated for the 1,300 largest UK registered companies, but not for TNFD, the nature-related financial disclosures, though this is the case that these are mandated in the rest of the European, sorry, I shouldn't say the rest of the European Union, since we aren't in the European Union anymore, but you know what I mean. So if we don't get some movement in the bill, can the Minister tell us when and how the government intends to bring forward nature-related financial disclosures, anything other than voluntary? But the missed opportunity I really want to focus on most today is the action that we need to tackle the financing of international deforestation. And I should declare an interest as Chair of the Forestry Commission. Deforestation and nature loss pose material risks to financial systems, as nature-related risks could reduce UK GDP by 6% over the next decade, according to the Green Finance Institute. The World Economic Forum ranks biodiversity loss as the second greatest long-term risk globally. Now, in the Environment Act 2021, we committed to bringing into force secondary regulations under Schedule 17 of that Act to prevent businesses from using illegally produced forest goods and to require them to exercise due diligence systems and introduce reporting. Ministers, if pressed, continue to state that an approach on this will be set in due course. I love that word, in due course. This is strange because the UK actually positively led and brokered at COP26 a deal to end and reverse deforestation by 2030. It was a real piece of global leadership. And since then, we've had government's own security assessment that deforestation-driven biodiversity loss and ecosystem collapse are high-level threats to the UK's national security. If you haven't read the security report, Global Biodiversity Loss, Ecosystem Collapse and National Security, do read it. It's short but devastating, and I would have a stiff gin by your side while you do read it. It's an official UK government security assessment, so it's not just us greenies being alarmist. Now, the 2023 Financial Services and Markets Act requires that the Treasury carry out a review to assess the extent to which regulation of the UK financial system is adequate for the purpose of eliminating the financing and use of prohibited forest risk commodities. So there is a commitment in that bill, in that act, to make sure that we do deal with the issue of forest products. So could I ask the Minister whether this review that is committed in the 2023 Financial Services Act is happening, and if not, why not, and when it will be undertaken, because its results could have been by now in this bill. So can I urge the Minister that at very least he persuade his colleagues in other government departments to lay the regulation under Schedule 17 of the Environment Act, which would make it illegal to use commodities in the UK that have been produced on illegally deforested land. This would at least be a step in the right direction. I don't know about you, but if you read the government's security report, which talks about terrorism, state threats, pandemic risk, economic insecurity, and everything else, including falling arches, I think you would be pretty scared by it. I certainly am. Let's not miss the opportunities of this bill to deliver on government's environmental commitments.
My Lords, this is primarily an enabling bill, and much of the substance will follow later through the FCA and PRA rulemaking and secondary legislation. Parliament will not have a proper opportunity to amend whatever the FCA agrees with the industry lobby. Consumer protection and confidence in the finance industry will be the biggest casualties. There is much to agree and support in this bill, but alas, it also omits crucial issues. There's no reform of short-termism in the City of London, even though for nearly 30 years the UK has languished near or at the bottom of the G7 and OECD Investment League. The investment gap cannot be addressed without reform of corporate governance, accounting, executive pay, law on dividends, and empowerment of stakeholders. Hopefully the Minister will tell us why these issues are not being addressed. Shadow banking is now bigger than retail banking, but there's no plan to regulate that either, even though shadow banking is likely to be the epicenter of next financial crash. In this vacuum, the bill continues with the deregulatory agenda, and more of the post-2008 crash reforms are being dismantled. The weakening of the senior managers and certification regime and accountability is one such example. Currently, complaints can be brought to the Ombudsman indefinitely, provided they are brought within 3 years from the date when the complainant became aware of or should have reasonably become aware of the event being complained of. The 10-year limit proposed by Clause 6 is a regressive step. How exactly are people supposed to become aware of the trigger events when governments and regulators seek to bury them? The Bank of Credit and Commerce International was closed in July 1991. To date, there has been no investigation.
So what is the how does the 10-year period affect the victims of that scandal? On numerous occasions in this House, I have referred to the plight of the victims of HBOS frauds, which go back to 2002 and 2007. The senior bank managers fleeced SMEs of around £1 billion. The regulators did little, the SFO, the FSA and the police passed the buck. In 2017, the Thames Valley Police and Crime Commissioner secured 6 criminal convictions. Still, the FCA, the SFO and the police did not fully investigate. The government of the day left it to Lloyds Bank, which owns HBOS, which then appointed Dame Linda Dobbs in 2017 to investigate and issue a report in 2018. To date, there has been no report, and victims are still awaiting compensation. Without an investigation and a report, victims of bank frauds cannot approach the Ombudsman. Taking HBOS frauds as an example, can the Minister explain when this 10-year window might commence under the clause in this bill? Clause 6, in my view, harms customer rights and allows banks to escape liability, and that is unacceptable. I am also concerned about restructuring the Financial Ombudsman Service. It was created in 2001 by Gordon Brown to adjudicate on financial services relationships that are inherently unequal. You have laypersons on one side and giant corporations with billions at their disposal on the other. Clause 8 severely narrows the right to seek redress by requiring the Ombudsman to prioritise whether firms technically complied with the FCA rules rather than whether their actions were fair and reasonable in the circumstances. The Ombudsman here is being asked to find in favour of the firms if they tick the right boxes, not by whether they took fair and reasonable action. Clause 8 also adds the concept of consumer responsibility when things go wrong. So even when a breach of rules has occurred and the firm has acted unfairly, the Ombudsman would be required to consider the general principle that consumers should take responsibility for their decisions. There are many kinds of consumers. We have individual versus corporate, amateur versus professional, those with or without expert advice, diversified or non-diversified. I do not know what kind of consumers this clause seeks to address. The entire clause really needs to be deleted. It is unacceptable that in this day and age, consumer protection is being diminished. I welcome absorption of the payment systems regulator into the FCA. I also welcome clause 14 and transfer of the regulatory powers of 22 trade associations to the FCA. This will eliminate duplication, buck passing, and ineffectiveness. It was a huge mistake by the previous government to make accountancy law and other trade associations AML regulators. In its 2018 report, the Office for Professional Body Anti-Money Laundering Supervision, the acronym is OPBAS, said, and I quote, "The accountancy sector and many smaller professional bodies focus more on representing their members rather than robustly supervising standards, partly because they don't believe or don't want to believe that there is any money laundering in their sector, partly because they believe that their membership will walk if they come under scrutiny." In its follow-up report in 2024, OPBAS said that it, quote, "has not seen any material improvement in professional body supervision." That is bad. This consolidation is totally justified and I will support it, and I hope that the ministers extend this to the regulation of insolvency and auditing as well. I look forward to hearing the minister's reply.
My Lords, it's a pleasure to follow Lord Sicker, and I always learn from his speeches.
The bill is laudable to promote growth by cutting regulatory barriers, compliance, duplication and fragmentation, and so reduce the burdens and costs for businesses and to support innovation. It aims to achieve these objects by giving the FCA new powers, as we've heard today, and I thank the Minister, the Noble Lord, for his very lucid explanation to the powers of the Payment Systems Regulator, which regulates credit card transfers, faster credit and BACS transfers are to be transferred, and the PRS abolished. The Financial Ombudsman Services regulatory powers for alternative dispute resolution under FSMB 2000, the anti-money laundering and counter-terrorism duties of the existing 22 professional bodies, and so on. The FCA will also have, as we've heard, the duties transferred from legislation such as many in the Consumer Credit Act. But the transfer of so many powers and functions to the FCA will not be a magic solution, nor indeed a solution at all, unless there is reform on how this regulator operates and how greater accountability can be achieved. The bill will therefore need some amendments if the FCA is to promote growth and cut regulatory barriers effectively, with better arrangements than those it replaces, since there are many queries about how the FCA operates. The Lords Select Committee, which has already been mentioned, its very good report on financial services regulation, found in 2025 that the failings of the two main regulators, the PRA and the FCA, include, and I quote, a deeply entrenched culture of risk aversion, getting in the way of doing what firms do best, competing, innovating and growing. One question here is whether, given such doubts, the changes proposed in the bill to how the FCA itself works, particularly in clauses 16 to 22, will lead to the regulator working to promote growth and competition, and whether there is, at the same time, sufficient accountability, predictability, and transparency, as well as the checks and balances we need. I'll comment on this in respect to the principles, which have had a very good airing today so far, and I hope you'll forgive me. Lord Burns, for instance, referred to the background to the 2000 Act and how they came to this solution, why, they seem sensible enough. Firms are obliged, amongst other things, to conduct their businesses with integrity, skill, care and diligence, take reasonable care with management and control, and pay due regard to the interests of its customers and treat them fairly, all of which seem pretty sensible. But how they have been interpreted has been a matter very often of subjective judgment. Smaller businesses especially have found aspects of the regulation baffling, lacking transparency and unpredictable. They therefore play safe and avoid risk, and hence often at the expense of growth. My noble friend Baroness Snopes and the noble lady Baroness Bowles referred to one of the proposals here, which is to take out the have regard to such principles. Baroness Bowles added that the problem is they need to be applied properly. I will say a few words about the application. The financial services regulatory lawyer Barnabas Reynolds has explained that the principles used as applied by the regulators can lead to considerable uncertainty given the subjective, often idiosyncratic judgments of the regulators applied to pin the blame on firms, and I'm quoting from something he wrote, on firms and senior personnel, regardless of whether relevant rules or guidance existed when the event occurred, since the principles are not used in the matter most of normal common law. To inform the interpretation of specific rules, the industry is unable to determine in advance whether many specific actions are permitted or not, and this is a problem of application. Indeed, the evidence of the Select Committee bore this out. Take Principle 12, Consumer Duty, the outcome of which the FCA intended was for consumers to have confidence in retail financial services markets with healthy competition based on high standards and good consumer outcomes. Witnesses explained to the committee that the implementation of the FCA had generated uncertainty, that the FCA had provided insufficient clarity around how it expected firms to comply, and the duty that it had created duplication and complexity within the duty. That implementing the consumer duty had been difficult due to the ambiguity of the rules and lack of clarity provided by the FCA. Now, this is in respect of the application of these rules about which the noble Baroness Bowles has spoken as well. The bill's accountability mechanisms, I would suggest, should be strengthened, and that could help deal with this problem of application. Noble Lords, you've heard, have objected to removing them altogether, and the danger of nobody knowing at all what on earth they will be judged by. So I would like to consider how we can insert clear obligations under law which can be judged in the courts, obligations for predictability, fairness, objectivity and transparency under law. They could be further promoted by obliging regulators by statute to supervise and enforce predictably in accordance with their rules, ensuring their decisions are consistent between firms which operate businesses of the same size and scope. They should be obliged to publish examples of predictable rulings for firms and how they were reached. In this way, there would be greater transparency, predictability would be enforced, firms as a result would be encouraged not to be risk-averse, certain in the knowledge that what the rules say they mean and can be established, and if not predictably enforced, can be challenged in court under law.
My focus here will be on climate change, and in particular whether the climate risk to the financial system is adequately addressed or addressed at all in the new arrangements that the government is putting forward in this bill, and with the potential consequences of that. And I think it is worth standing back on this. We all know that at least the complacency about the subprime market in the US resulted in the 2007-8 financial crash, something few were paying attention to. That crash had global effects. The City of London, and therefore the UK economy, were particularly badly affected. I recall the panic of ordinary people who feared that their savings would be lost and queued to draw them out, with widespread retail bank failures on the cards. Strenuous and expensive efforts were made to prop up the banks to protect customers. The UK Treasury injected almost £140 billion into failing banks at the peak of the 2008 financial crisis. The government provided a further £1 trillion in financial guarantees and liquidity backstops to stabilise the financial system. We need to remember that, and we especially need to remember the consequences. Austerity for years, living standards frozen, people feeling left behind. Many have argued that this contributed to Brexit, as people thought that coming out of the EU would improve their financial position. As was predicted at the time and has now been borne out, this actually led to major damage in the UK economy, far from improving things. Then came the expenditure on the pandemic, and the cost to the UK economy grew. people's living standards have not improved for 2 decades. And it's not surprising that we now see moves to the populist right and left for simple and immediate answers. Economic challenges have their social and political effects, as we've seen before. Therefore, this bill matters. The government is right to seek growth in the economy. The financial sector is rightly identified as a potential source of growth. Clearly, where regulation is serving no purpose and is obstructing that growth or is out of date, then it makes sense to reform this. However, we need to be acutely aware of the huge economic, political and social costs that have resulted from lax regulation and regulators not properly focused on real threats. That's what we need to guard against. And Baroness Noakes has decimated the proposals to reduce parliamentary engagement and the removal of regulations into various strategies. So let me come to my focus here. Just as we have a new landscape in crypto, for example, we need to be aware of climate change as a current and future risk to the financial sector over both the short and the long term. Clause 17 removes whole swathes of protection to be replaced by as yet undefined strategies. The FCA has been given huge new responsibilities when we know that regulators have a poor track record in monitoring areas already under their responsibility, let alone horizon scanning for new risks. The deletions in the bill take out regard for climate change, the need to focus on sustainable growth and to be compliant with the Climate Change Act, as Baroness Hayman mentioned. Yet, as Baroness Young said, the UK remains well positioned to capitalise on its reputation as a hub for sustainable finance. But I would go further. We need now to be acutely aware of climate risk. Therefore, we should be strengthening, not weakening, the rules here. I hope that everyone has read, at very least, the summary of the recent report produced by the Adaptation Committee of the Climate Change Committee, chaired by our colleague Baroness Brown of Cambridge. The world is currently on a path to around 2 degrees above pre-industrial levels by 2015. We will not return to pre-industrial levels. Our aim has to be to stop further escalation in global heating, but also to seek to adapt for what is already our new climate. There will be parts of the world where this is far more acute than in the UK, but the financial sector is global, with implications back to our own economy, society and politics. A global threat even beyond subprime markets. The priority risks in the UK alone are intensifying heat, a growing flood risk and rising drought and wildfire risk. The risk to the insurance industry is obvious. The adaptation report points out that flood-related insurance claims are rising. Home insurers have paid out more in claims than they received in premiums for the 5 years to 2024. They conclude that by 2050, under 2 degrees centigrade global warming, many homes and businesses may not be able to access insurance at all. This threatens the viability of the property market, the economy, and the sustainability of communities. As the report states, a large insurance protection gap means many homes and businesses cannot access insurance due to a lack of coverage or high premiums. It also puts stress on the financial sector as banks face higher default rates on mortgages and business loans and on public finances through disaster support needs. The 2039 end date for flood and reinsurance scheme is also at the moment creating uncertainty in the property insurance market, having an effect on the housing market, as happened with subprime mortgages. As the report states, and I quote, "Actions by financial institutions are needed to ensure that physical climate risks don't disrupt the financial system. The actions will support the maintenance of essential financial services across the economy. The UK is home to the biggest share of international bank lending and borrowing. It's the largest market for international debt issuance and the world's largest specialty insurance market, as well as the world's fourth largest insurance market overall. One can see parallels with what happened leading up to the 2008 financial crash. The current risk to the housing market and to the insurance industry is clear. Therefore, it is vital that climate risk is included on the face of the bill rather than excluded even from regulation. This is one challenge which unfortunately we can be absolutely sure will persist for many years to come, way beyond the life of this legislation, and therefore must be enshrined within this bill.
My Lords, it's a great pleasure to follow the noble lady Baroness Northover and to agree with her warning. I will add the phrase carbon bubble in here as the further financial risk. And I also must cross-reference her contribution to the words in the opening from the noble Lord the Minister about increasing the insurance business in London. This seems like a very bad idea indeed in face of the risks that we face in the climate emergency and nature crisis. And I note that we are right at this moment facing the risk of an extreme El Nino with impacts we should well understand. But, my Lords, here we are again. I join a small but merry band of Financial Services Bill veterans. This is my third, and welcome the Minister to our group and look forward to our deliberations. I say look forward genuinely because this is the most positive start to such a debate that I've heard. There was a great deal in the speeches thus far that I agree with, more determination than I've heard previously in your Lordship's House to at least start to tackle what economist Anne Pettifor has termed the global casino, of which the UK financial sector is a significant part. And we didn't just hear those powerful words from the noble Lord Seeker, always welcome as they are. That makes a welcome change. When I first took part in the debates on what became the Financial Services and Markets Act 2021, I was new enough to be shocked at the narrowness of the debate, with the Conservative government reducing regulation and controls, while the Labour front bench just nodded along. Amendment after amendment at committee and report stage came from those wanting the government to go further and faster in deregulating, in letting the financial sector rip, even though it was little more than a decade since we'd seen the cost of that in 2007-2008. Today, though, we've heard from the Right Reverend Prelate, the Bishop of Manchester, powerful words about the financial sector's not just failure to meet the needs of many parts of our society, but also the damage the sector does to many of the vulnerable. I haven't yet persuaded the House's champion against child poverty, Baroness Lister, to take part in one of these debates, but I hope one day she and others will, because finance is far too important and damaging to be left to the bankers. Today, the noble Lord Sharkey was speaking up for the interests of consumers of financial products, so often the victims of predatory practices, not just by the fringes of the sector, but by the highly profitable giant organisations at its heart. And I associate myself and the Green Party with those remarks, while declaring my membership of the APPG on investment fraud and fairer financial services. And we heard from the noble lady Baroness Hodge of Barking, well known for her championing of action against corruption, about the need to tackle the rampant corruption and fraud. Although I don't agree with the noble lady's conclusion that we're talking about a few rotten apples, rather than structurally embedded corruption with roots going back centuries. After all, the City of London, and with Crown dependencies, so disturbingly highlighted last week in an exhibition in Portcullis House that unsurprisingly attracted a great deal of negative attention, is, as the then Deputy Foreign Secretary Andrew Mitchell said in 2024, a conduit for nearly 40% of the world's dirty money. And as Lord Evans of Weardale said in 2022 in a debate on corruption secured by my noble friend Baroness Jones, we have clearly, as a matter of policy, turned a blind eye to the perpetrators of corruption overseas, using London for business or leisure purposes. That, of course, has been helped by those enablers to which the Noble Lady Baroness Hodge referred. Looking back to 2020, if fellow Lords had expected me to take part at all in the debate, they probably would have predicted I'd make comments resembling those powerfully made today by the Noble Lady Baroness Hayman and Baroness Northover, work on which Peers for the Planet has been so prominent, in pointing out that there is no financial sector on a dead planet, that the economy is a complete subset of the environment. But the House was in for a shock in 2020, perhaps not for the last time. When I spoke then about corruption and the City of London's place at the heart of it, I got more than the odd gasp and fervent head-shaking in opposition. This was then when for the government, Lord Agnew of Alton was saying, the UK is internationally recognised as having some of the strongest controls worldwide for tackling money laundering and terrorist financing. Well, on these subjects, my lords, we have come a long way, as indeed the noble Lord Agnew did in his views. The debate has shifted far closer to where the Green Party has always been, saying, as the noble Lord Equal said, in the relationship between society and the financial sector, the settlement is not working. The financial sector is not providing the appropriate support to the real economy, is extracting excessive profits from its traditional sectors and from parts in our society in which it should have no place, such as children's social care and aged care, and water companies and many other public services. And excessive pay is being extracted, as the High Pay Centre has been so prominent in highlighting. And the sheer size and risk-taking threatens the security of us all. We have too much finance, so this bill should not be seeking to grow more, as well, of course, too much corruption and fraud. There is another way, as the Global Justice Report by Thomas Piketty's World Inequality Lab demonstrated this week. And there's also an issue not yet raised by others, the cost of the speculation in the prices we all pay for the basics of life, for food, for fuel, the impact of the financial sector's bulking up of lending on house prices. Food security, as the Green Party is trying to get the government to understand, is a huge and present issue in the UK, and the financial sector is a significant part of the problem. Now, the noble Lord Equal said risk aversion has its uses. I can only agree. He questioned, however, the cost to the sector of regulation. But the cost to all of us, of course, in getting it wrong is enormous, possibly existential. We must not forget how close we got in October 2008 to total collapse. It's customary at second reading to mention issues that one wishes to raise at committee, and I think I've pointed to my areas of interest: making the financial sector work for the real economy, tackling corruption and fraud, protecting consumers, and of course nature and climate, and tackling the costs of speculation to us all. But I will raise one final issue, which I will be tackling within this bill if I can find a way, an issue that politicians around the global north have been facing for a long time. I go back to US President Roosevelt in 1936, and I quote, "Business and financial monopoly, speculation, reckless banking had begun to consider the government of the United States as a mere appendage to their own affairs. We now know that government by organised money is just as dangerous as government by organised mob." We have, just down the road from us, the City of London and the City of London Corporation, which has a unique, archaic and dangerous place outside the rules that apply to the rest of society, rules about democracy, rules about transparency. This is a place where organised money rules. I mentioned the APPG on investment fraud and fairer financial services. Well, I'm working with it now on a survey, asking for views whether the corporation should be maintained as it is, reformed or abolished, as a Royal Commission recommended in 1894. We've come a long way in our understanding of the issues in the financial sector. We will have to see how far we can go, because we need to grasp, as I respectfully say to the Minister, that the City is not one of our greatest economic success stories, but an entity that needs far tighter, stronger controls from the government for the security of us all.
Now, if we've got green technology on households and businesses everywhere, then we'd be less reliant on Russia, on China, on Iran, So why is there no financial product that the householder can get hold of to put, say, solar panels on their roof and the country benefit and them benefit? Or a product for schools to do the same thing? Or a product for an NHS trust to do the same thing? Because if the technology works and the technology is sufficiently profitable, then a good financial product would make common sense. But I see none for schools, I see none for NHS trusts, and I think those for householders and small businesses in particular are rather limited. And I'd be interested in the Minister's observations, because it seems to me that's relevant for this bill far more than it's relevant for the Energy Secretary. Second, the Minister was very bullish about how mutuals and cooperatives are going to double. We're 2 years into 5 years of a Labour government. I'd be interested to know if we're 40% towards that doubling now, and if not, which are the sectors that are going to lead the way in the next 3 years and how. And I'd also be interested, perhaps in writing, to understand with one small sector, county cricket clubs, whether it's the government's expectation that in the next 3 years they will be as mutualised as they are now, or significantly less so. My third and my substantial point is on financial mis-selling. I've raised already previously the V11 group, working class footballers who were done out of their investments by fraud. Now, the experience looking at exactly what happened to them is very similar to what happened to coal miners. Separate case, not financial fraud, it was lawyers who were ripping them off, that obviously taking money. There, the Ombudsman did a special report in 2008. I managed to get 43 firms of solicitors disciplined and fined. I got 12 removed from practice. Now, if we take the financial sector and what's happened to those former footballers, but also to many other groups in society who've been missold products, I don't see the same system. My dealings with the Financial Ombudsman Service, I did as Vice Chair of the Treasury Select Committee in another House, have to deal with them for 4 years. I found them lacking in purpose, losing skills, experience all the time, and I didn't see the level of leadership needed to take hold of things. How is that going to change? And I hope it will, with a shift of power to the Financial Conduct Authority. If we look at the V11 case as an example, the fraud was palmed off to the Serious Fraud Office and to the City of London Police. Why? Why to one specific police force? My dealings with the SFO when it came to the coal miners and the legal scandals, which were mega. I got money back for more than 2,000 of my then constituents and millions of pounds back. Why is that not being handled more effectively at the beginning? Because in this case we're talking financial mis-selling, which is a conduct issue, but also fraud, which is a policing issue. And there's a mishmash in the middle. And I want to be convinced that the Financial Conduct Authority will cut a way through that. Because you see, if working class people, let's say sports stars, let's say musicians, come into money and find others taking their money away from them by mis-selling, or worse, by fraud and mis-selling, well, why will they invest in those products in the first place? And in the case of those footballers, of course, and Kingsbridge Asset Management, ones that were brought forward by the government in terms of developing the UK film industry, put forward by then Chancellor Gordon Brown, as the right thing to do. But if working class people do the right thing and get some money and invest it, who's going to protect that? People who are not surrounded by good accountants or any accountants or good lawyers or any lawyers when they first get money. And if we look at the financial fraud cases, we see case after case after case where people are getting done over by people who appear to be cleverer than them, giving them advice and mis-selling, and the system is not helping them out. That's fundamental, and that's the bit that I want to see more of in this bill. Because if we're appealing to the country to say, do the right thing, invest in the future, whatever kind of investment, there has to be the guarantees, and the system has to be robust enough that somebody, when there's wrongdoing, is going to sort it out. And the mishmash of the SFO and the City of London Police, that is not a system. That's a hope, and it's a failed hope, and proven to be a failed hope. So if the FCA is taking that responsibility, my question of the Minister, what precisely is government going to say to them in terms of the systems, the skills, the reporting back, including to Parliament, that they're going to give to show that they are up to the mark in being able to handle the mis-selling and handling the fraudsters? And have they got the powers they need to prosecute? Because it seems to me that is fundamental. The separation of prosecution and those looking at financial mis-selling is one of the lessons from the V11 and the loan charges and the other scandals, the multiple scandals that we've seen in the last 2 decades. People need to be confident in the city, in the system, when it comes to financial services. We need to make sure they are. I look forward to hearing from the Minister on what precisely he's going to say to the FCA should this bill be passed and they be given more power.
My Lords, it's a pleasure to take part in this second reading debate. In doing so, I declare my technology interests as advisor variously to the Crown Estate, Indava plc and Simmons & Simmons LLP. Can I congratulate the Minister on the clear and cogent way he introduced the provisions in the bill. I will largely concentrate on what isn't in the bill, but by the time we get to third reading, I hope maybe in the bill. Turning to AI, first of all, it's across our society, across our economy, throughout our financial services, be that in fraud detection, credit decisioning, algo trading, any part of financial services, and yet currently the bill is strangely silent when it comes to AI. The regulator merely having to use existing powers which were never designed for these new technologies. Can I ask the Minister to that effect, what does he believe is the right approach in this bill when it comes to AI, in that the government have stated they're taking a domain-specific approach, leaving it to the individual regulators. But if one takes that approach, how can any consumer, how can any customer of a financial services product be guaranteed clarity, consistency and a coherent approach when they avail themselves of financial services, not least because there are 2 regulators in this sector? And if you're a business, you may well have dual regulatory responsibilities. How will it work to not have horizontal, cross-sector AI regulation? Moving to cyber, again, nothing in the bill when it comes to an effective framework for cyber resilience. In contrast to AI, the government have decided on cyber, you can have a cross-economy, cross-society approach. So can I ask the Minister, what's different about cyber? Why can that be seen to be cross-sector, but AI not so much? On financial inclusion, I welcome the provisions around access to banking and to in-person services. As other noble lords have mentioned, though, the devil is largely in the detail as to what precisely is meant by those services. There is almost no point whatsoever having a branch open if when you go into that branch you're told there's a machine or a screen in the corner which you can go and use. How is that financial inclusion? How is that digital inclusion? And when financial exclusion and digital exclusion all too often walk hand in hand, we need greater clarity on the face of the bill when it comes to these financial inclusion and access requirements. Moving along, we should consider what the third largest economy in the world is. The United States first, China second, in third place, fraud and economic and cyber and financial crime. 10.5 trillion, which could be hospitals, schools, teachers, nurses, doctors, defence, any potential element of state spending. And one can be sure that the UK is losing its share of billions in that financial crime and fraud. And yet, where is the modern framework in the bill to address these new fraud vectors, not least AI-enabled fraud? Why is there not more on the face of the bill looking to see how AI can be deployed as a sword and a shield against nefarious use of AI? To financial education, there are a few nods and winks in the bill, but we need to see much more on this. If we're to have less of the asymmetry between customer and firm, then financial education is critical to this. Can I ask the Minister how the government, the Financial Inclusion Committee, the Money and Pension Service, who do such great work, and the firms themselves can be brought together to have a far greater coherent and consistent approach to financial education for all? And how will this tailor with what's currently proposed with the excellent Francis review into the curriculum, and what will financial education look like in that? My Lords, there are many positive provisions in the bill, but for me it is marked by errors and omissions accepted. There is so much which is not in the bill which needs to be in the bill. A significant financial services and markets bill, significant and yet silent on AI, on cyber, quiet if not completely silent on financial inclusion, fraud and financial education. If this continues unamended, these issues unaddressed, individuals, our communities, our country will be the worse for it. Under-enabled, under-empowered, and as a consequence, more than sub-optimal economic activity as a consequence. My Lords, we have the bill. We don't need to make it bigger, but we can make it better.
My Lords, I welcome the opportunity to contribute to this debate on the Financial Services Bill, in particular to consider its implication for local authorities, local communities, local authorities, and the people we are here to serve. At a time when High Street continue to face significant challenges, there are aspects of this bill that deserve recognition and support. One of the most important is the effort to preserve access to essential banking services. For many people, particularly older residents, small businesses and those who are less confident using digital services, access to physical bank branch remains vital. The closure of bank branches over the years has had a profound impact on communities across our country. A local bank is not merely a place to deposit money or seek financial advice. It is often an anchor institution that helps sustain footfall, support local businesses, and contribute to the vitality of the High Street. In many communities that I have visited, the loss of local bank branches has been felt just as keenly as a loss of local post offices. Measures that seek to maintain access to cash and banking facilities therefore have benefit that extend far beyond the financial sector itself. They help keep our town centres active, accessible and economically resilient. The bill also contains provision aimed at strengthening consumer protection and promoting a more competitive financial services sector. If implemented effectively, these measures could improve access to affordable financial product, encourage innovation, and help ensure that customers receive fair treatment. Such outcome would be welcomed by households facing continued cost of living pressure and by small businesses seeking access to finance and investment. However, while there is a much to command in this bill, there are also important questions that deserve careful consideration. Local authorities have long played a crucial role in supporting vulnerable residents, promoting financial inclusive and responding to local economic needs. They possess local detailed knowledge of the challenges faced by their communities and are frequently the first to identify emerging problems. I would therefore be grateful if the Minister could clarify how local authorities will be consulted as a new regulatory framework and when powers are implemented. What mechanism will exist to ensure that local knowledge will be used in decision making? How will Council be able to raise concern where changes in a banking provision, financial services or regulatory practice have unintended consequences for local residents? I would also welcome clarification on how the government intends to measure the impact of these reforms on financial exclusion. What assessment has been made of the effects on rural communities, deprived urban areas, and those who continue to rely heavily on face-to-face services? Furthermore, what safeguards will be put in place to ensure that transition towards digital financial services does not leave behind those who are least able to access them? Finally, can the Minister explain how the government will balance this regulatory efficiency with equally important need for local accountability and community engagement? My Lords, the success of this bill should ultimately be judged not by its effect on market and institutions, but by its impact on ordinary people. If it helps maintain vibrant high street, protect access to essential services, strengthen financial inclusion, then it will make a valuable contribution. But we must also ensure that local authorities retain a meaningful voice in shaping the outcome for the communities they know best. Thank you.
My Lords, I too welcome this bill as an important step to strengthening the position of London in the world's financial markets. But I also would like to pay tribute to the regulators, particularly the FCA, who have had to cope with markets that have changed enormously over the years the FCA has been in existence. But the fact that one extends praise to them does not mean that things don't need putting right, and there are two areas I wish to address. The first is the whole problem of climate change, which has been so ably addressed by Baroness Hayman and Baroness Northover. I agree completely with what they've said. All I wanted to do was to underline the effect this is having. There is worldwide litigation in almost every country in the world about the risks of climate change. And banks and regulators, central banks and regulators worldwide are concerned about its impact. We must therefore ensure that this bill is fit to deal with this problem and to ensure that regulation of the financial markets, because of what is involved for the longer term, deals properly with this area. The second area I wanted to turn to was the control, and I use that word deliberately, that Parliament should exercise over regulators and their accountability. And in doing so, I ought to declare my interest as Chairman of the Financial Markets Law Committee, though I speak in an entirely personal capacity. And I think one symptom of the current problem can be taken simply from the volume of litigation. We all suffer in this House, and everyone complains about the thickness of the bills and the statutory instruments we have to look at. And maybe this is the problem of our age in being unable to express ourselves concisely enough. But it's an extremely serious problem in the financial markets. Last year, the FCA produced 1,918 pages of regulatory instrument. Now, the fact that so much legislation is being produced, Lord Pitt Wilson gave an illustration earlier of the change, shows that someone needs to ask to hold the regulators accountable. Why do we need it all? And there are 5 points I'd like to make. First, I really think there is a serious problem with clause 17 of the bill, because of the weakening effect it has on transparency, proportionality, and, as Baroness Noakes so clearly demonstrated, the more insidious impact it will have on the ability of this House to scrutinise bills. We must increase scrutiny and outside control, because fundamental to any body that makes laws, or, as in the case of the FCA, also enforces them, is accountability. And I think there is a plain lack of accountability. Secondly, I accept, as the Treasury rightly point out, that expertise is required to draft the regulations. These transactions, when I look at them, are transactions of immense complexity, and you really need to understand the market to draft them. But that doesn't mean that you don't need someone looking over your shoulder to see whether you're getting it right. It's very easy to see just trees and forget the wood. And what I can't understand is why isn't the regulator very happy for someone to look over what they're doing, because if things go wrong, it is a mighty source of comfort. And there is no doubt we shall have another financial crisis in a way none of us can anticipate. Thirdly, I think there's a wider issue as to the form of rules. I think we've got to a stage now where we produced very detailed rules, and I think we have to ask ourselves 2 questions. Is this the right approach? Because I think and compliance departments like detailed rules, because if you have detailed rules, all you have to do is go through them all and tick, 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 and you've complied with your obligations. But that shouldn't be the test. The test should be, have you complied with the principles? And I think what we're in the danger of doing is transferring to the regulator the risk that market participants should have in complying with the underlying principles and not merely with the tick box exercises of dealing with rules. I pointed this out when, with a co-inspector in the system of inspections we used to have many years ago, we said that one of the problems with the whole Maxwell problem was a tick box mentality, and we must always remember that. But there's a second matter to which it's also necessary to point out, that if you have very clever people, and one of the regulator's difficulties are that the people he supervises pay so much money, you can always use rules to justify what is done. And it's worth turning up what happened in Enron. Time does not permit me to explain, but Enron is a classic case of applying rules to produce a result that was completely contrary to the underlying principles. Fourthly, cost. The point is very shortly made. Long and complex rules are very, very expensive. And fifth, consultation. It's very, very important that we look very carefully at the provisions in the bill relating to consultations with the market. It is very easy, as long experience has taught me, that when drafting you can overlook the obvious. And I think we've got to be very, very careful in what we permit the regulators to do without consultation with the market. For those reasons, therefore, I very much hope we will scrutinise these two areas of the bill in particular. And may I again pay tribute to Baroness Noakes for the extraordinarily lucid explanation she gave of the problems with Part 3 and in particular Clause 17 of the bill.
My Lords, for 14 years I was the most junior opposition Treasury spokesman. A slight problem with that is I was occasionally, in fact more than occasionally, the most senior opposition Treasury spokesman, largely because there was only one of me. Settling into being a backbencher, I glanced at what was coming ahead and decided I had sort of a duty to participate in this debate and learn. I've looked at the bill and concluded that it is, I'm going to call it motherhood. What I mean by motherhood is not to belittle it, but part by part, it attacks individual problems, proposes solutions, and we'll be very good at that. We'll work at it and we will get hopefully a good result. The only bit that hit my eyes was clauses 39 and 40 on ring fencing. The global financial crisis in 0809 was right at the beginning of my career as an ill-informed front bencher. I've been through virtually all the bills. I think only the noble Baroness and I think, have been so consistently there, but there was also, of course, Baroness Kramer. We had in 0809 the global financial crisis, and we really have to remember that. It's been mentioned that there's going to be another one. We don't know what it is, but we should think about how we are prepared for it, and I couldn't agree more. The financial crisis we had in 0809, the world teetered on the edge of financial chaos. It was solved by a lot of people, but I'm particularly proud of Alistair Darling and Gordon Brown for what they did in those weeks when we really didn't know what was going to happen next. After the crisis, we created the Independent Commission on Banking, the Vickers Report, which reported in September 2011, and they proposed ring fencing. Now, I must say, the consensus view on our side was it was a good report, good commission, great people, and the output produced general approval, including from me. In anticipation of this debate, and looking at the ring fencing being the most significant point that it touched on, I decided to read a few reports. I read the Ring Fencing and Proprietorial Trading Independent Review by Keith Skeoch. I apologise to him if I've got the name wrong, but it's a fascinating document which was published in March 22. The Treasury produced smarter ring fencing regime in November 24, and the Safeguarding and Stability once again from the Treasury in May 26. I'm afraid I concluded that the ring fencing regime was doing little good and in many parts harm. It has been overtaken in the area of protection by the Bank of England's approach to resolution, October 2017. I became fascinated, yes, really funny things that happen to you in old age. I became fascinated by this resolution stuff and managed to get somebody in the Bank of England, the official who is in charge of resolution, to give me a series of seminars on the telephone. He was a bit suspicious, so he said he had to have his solicitor with him throughout the conversations. I feel I understood it. And I think the claim that's made in some of these reports that all the good fencing produces is covered by the resolution regime. But the resolution regime, in the end of the day, takes years in preparation as various banks are persuaded to take particular actions to make them more robust in a crisis. But it actually happens in about 60 hours over a weekend. It's a very elegant process and they have enormous powers. And I feel there is a strong case for a relook at ring fencing, recognizing that the resolution regime gives all the protection. We mustn't lose sight of the fact we were trying to do. We were trying to avoid the too large to fail dilemma. The resolution regime does that. And it doesn't just do it for ring-fence banks, it does it for all banks. It achieves almost certainly the minimum cost of the public purse, normally no cost to the public purse. It prevents systemic impacts. Now, the reason I'm making this so short is because the only bill that goes into the details about 40 minutes, and I didn't think this was the time of the night to start on it. I have to simply say, I hope I will be able to find a way, or hopefully perhaps even find some support, to produce amendments in the bill so that we can have a proper discussion that looks at whether ring fencing is still fit for purpose and the extent to which the resolution regime can take over much of its work, and the rest of the work it does, if any, can be distributed within the regime, and particularly we can take away the detailed problems all over the place in its application, which is a negative to the system, and also essentially remove the fact that there are two regulators, which is always a bad thing, especially when one is going to take over at the last minute, as the Bank of England has the power to do in the resolution regime.
My Lords, can I just, as the first of the winding speakers, to say I want to thank the Minister for his willingness to meet. I suspect after listening to what I think has been an extraordinary and exceptional debate, just everything a powerful contribution, he now knows this is not a small technical bill that is going to slide easily through this House. My Lords, we've agreed generally that financial services sector contributes something like 10% of the UK's economic output, and consequently that innovation and growth in this sector matters. But I also want to pick up those points that others have made, that it's important we don't repeat the mistakes of the past. This sector brought the UK economy to its knees. Baroness Northover, that's Lord Davies of Brixton, to some extent Lord Tunnicliffe, gave us a feel of how damaging that was at the time. I mean, to say the world teetered was probably the right phrase. But the consequences have dragged on way beyond that. And the consequences still have deep impacts on us today, on an ordinary people dealing with their cost of living. Now, following that crisis, the revised regulation that was put into the books was based on precautionary principles. Now, I've no objection ever to streamlining and efficiency and eliminating duplication, and I can agree that some measures went too far or were too broad. But this bill fundamentally changes that precautionary approach and replaces that principle with assurances of enforcement action in relation to poor or corrupt behaviour, and in terms of bank failures, of the resolution that's a scheme that's coming to the rescue, that's as Lord Tunnicliffe described. And I really question whether the bill adequately structures the capacity to make the shift. In the case of enforcement, I've asked the Minister directly to demonstrate to me that enforcement has teeth. I talked with the City again this morning, and frankly, they laughed. And it's one of the reasons, if we can't have certification and precautionary principles around fit and proper, then enforcement is absolutely critical. And I do want to hear much more from the government on that issue, and that's just one example. In the case of the resolution, this picks up Lord Tunnicliffe's point, but I disagree with him completely, that we don't need to have ring fencing because we've got a resolution regime in place, or we can have a mixture of, we can weaken the one because the other exists. Will the Minister be able to actually look me in the eye and say that he would activate a bail-in bond scheme if a big bank failed, because the consequence would be huge financial instability amongst those who held those bail-in bonds, and I'm talking about the insurance companies and pension funds. Many would be on the verge of collapse if we ever exercised bailing in those bonds. And it's one of the reasons why in the financial crises that have happened, no government has ever taken that step. There's a minor issue around ring fencing, though. I mean, I think there are lots of issues there. And I will want to pick up the one on intrabank group services, because the removal of the ring fence there, I'm just giving notice to the government, that allows services to be brought in from overseas bodies that are not regulated by any UK authority. So there's that issue. But around these issues, we heard from Lord Eatwell, who I know is very concerned about MREL and whether or not bail-in bonds could ever be used, Lord Davies of Brixton and others. Now, I also want to join my colleague Lord Sharkey in his utter frustration at the undermining of the FOS, of the Financial Ombudsman Service, and the narrowing of protection, the sort of narrowing of free and fair redress. And we are going to take that on in this bill. So I want to join Baroness Noakes, a really truly brilliant speech, but also Baroness Bowles around the same issue. That's Baroness Northover, Lord Thomas in some ways. Baroness Noakes used the word shock, that regulatory principles to be applied by both regulators, which currently sits in primary legislation, that's proportionality, fairness, responsibility, transparency, and yes, regard to climate change, are removed from primary legislation by this bill and reduced to elements in a 5-year strategy document. Those regulatory principles are Parliament's instructions to the regulators, and they will now have no legal standing. If the regulator does not pursue them, there can be no action in court, there can be no charge of judicial review. It is entirely up to the regulator whether or not those principles are observed. And I note it's very clear in the bill that the strategy document on which we will now depend can be revised at any time with no consultation. And the regulators are really merely required to note in their annual reports whether or not they have bothered to have any regard to the principles. Now, the main purpose of this change, and we've seen this pressure before from the regulator, is to cut Parliament out of any control over the principles of the regulator and to make sure that there is no additional recourse when they're abandoned. This change has to go, and I suspect that will be the verdict of most of this House. But that brings me not just to commissions in this bill, but to the omissions. And I'm really grateful to Lord Holmes, who raised issues around AI and cyber, about which I am frankly not sufficiently informed, but I'm sure he's right that they need to be addressed in this bill. But the omission that exercises my party the most is around the access to financial services for both small businesses and disadvantaged individuals who are very poorly served at present. And these issues were eloquently addressed by Baroness MacLeod, the Right Reverend Bishop of Manchester, Baroness Hyde, Lord Kamau, Lord Sahota, really powerful discussions. This bill does take some necessary steps on credit unions, credit data sharing, and permits action on the anticipated Lloyd review of in-person banking. But it could go so much further. And to bolster, and I'm so glad Lord Kamal and others have mentioned this, that community development financial institutions, including credit unions. With thanks to the fair banking movement, I will propose a rating system to show where there are shortfalls in lending and other financial services. And then I will go beyond that to propose remedies, including mechanisms to provide investment into CDFIs for those banks that don't wish to change their lending practices. A revival of local banking, which has largely been discarded in the business models of the big banks, would drive up growth, jobs and living standards in all of our communities. My Lords, the US tech sector is brilliant at not paying its way at the expense of British competitors. Online platforms facilitating fraud should have reimbursement liability, not just the banks. We hope we can find a way to bring in that change. We also insist that across all recognised payment systems, including big tech, participants, not just the banks, must be subject to the levy to support financial inclusion. Again, I hope we can bring in language for that. We should also use this bill to face up to the expected risks in financial stability. And a key concern is the burgeoning private asset market, now $18 trillion strong, and the private credit market, discussed by Baroness Bye. But it's interconnected through lending, investment and derivatives throughout the regulated financial sector. That private market is opaque, it's an intermingling of excellent credit and complete garbage, and it easily becomes illiquid. I want it to be a clear responsibility of the Bank of England and the PRA to assess the risks of a broad-based credit crunch in private markets. I'm also concerned that the regulatory perimeter, which excludes small businesses from most FCA protections, may become a serious issue in a private credit crunch. So I'm going to seek to add to the regulator's principles consideration of the risks arising from these issues. My Lords, digital payments and finance are coming at us fast. We can't be King Canute, but frankly, we have had enough of scams and money laundering. That's Baroness Bye, very extensively Baroness Hodge talked about the importance of taking action to deal with enablers. But I think this bill should also be an opportunity to get in place the right guardrails for crypto. And I'm very much behind putting requirements on the tech sector and requiring the stablecoin exchanges to act against fraud, sanctions busting and money laundering. But I'm not sure this should be done through Henry VIII powers. And I'll give you a reason. I'm concerned, for example, that in exchange for putting these requirements on stablecoin exchanges, the Bank of England is proposing to step in as a backstop if they have liquidity problems. They've made that statement publicly. Now, even in the US and in the EU, no government will touch that offer of a liquidity backstop with a barge pole. It's such a big issue, this is an area where Parliament should be making the decision, not the regulator. History tells us those who cannot remember the past are condemned to repeat it. If we repeat 2007, we lose all our chances to seize the opportunities for the future. So I and my colleagues will try to make sure that Parliament's voice remains, the guardrails are in place for the financial sector and even for crypto, with the tech companies paying their share. And we will see game-changing improvements to achieve access to finance for all communities, individuals and small businesses. Fair and sustainable growth is more than possible, and it is what the public expects of us.
I thank the Noble Lord the Minister for hosting this debate with such courtesy and speaking so well at the start, and declare my interest as Director of South Northern Street Capital and also as a former Director of the Cooperative Bank. I would start by following the words of my noble friend Baroness Neville Rolfe in saying that we welcome this bill. It addresses a widespread sense that financial regulation has become a little too complex. And that sense we've heard this evening in debate, but that sense seems to be held by the Treasury and also by the National Audit Office, and clearly by the government. And the government has generated multiple reviews and inquiries that underpin the clauses in the bill. Just looking at a few of them to start with, Clause 26 follows the Committee on Banking Standards, and this is the clause that looks at the senior management regime and where there's a huge need for reform and a reduction in bureaucracy, and the government has asked for a 50% reduction in bureaucracy, which we would welcome. The senior management regime itself is really quite a complex thing and probably doesn't quite do what members of your Lordship's House would expect, partly because some of the people who participate in it don't fully understand the regime themselves or what their obligations are. And then turning to clauses 16 and 17, these are the two clauses quite controversial and spoken about this evening. The one on the 5-year plan, this is the unsupervised 5-year plan of the FCA, and the other on weakening the link to the regulatory principles. Noble Lords this evening have spoken about the importance of oversight and keeping an eye on what the FCA is up to, but going right back to the beginning of how the regulators were set up, and the Noble Lord Eatwell reminded us of his participation in it, and Noble Lord Burns, that when the Financial Services Markets Act was set up in 2000, it established there would be a cost-benefit analysis that would hold the regulators essentially to account, to be honest, in how they develop regulation. And the FCA is actually running a review at the moment of cost-benefit analysis with Dr. Felix Martin, and we might, at the very least, hold the regulators to that part of their own obligation, proper cost-benefit analysis, and proper supervision of the cost-benefit analysis, and that's even before we get to proper supervision in Parliament, which we've only just managed to put in the last bill, as you know. And turning to clause 39, this is on the ring fence, and it was interesting to hear the words of Lord Tunnicliffe on the ring fence. So the ring fence, of course, the ring fence clause also sits on a variety of reviews, in particular the Keith Skilk review of 2022. And it is worth remembering what the review in 2022 said, which is it did support the ring fence, but it was very explicit on a few other points, one of which was it's very expensive. So there's an economic burden of running this ring fence regime, and it's something of the order of £1.5 billion a year. But he also said that the benefits of the ring fence regime would be diminishing for the reasons we've just heard. They're diminishing because of the strength of the regulatory regime elsewhere, in particular the resolution regime. And then he went on to add that the ring fence might lead to ossification, it's quite a strong word, in retail bank services. And we might hope that hasn't quite happened, but we know that there have been closures of hundreds of bank branches. And so we might expect that the closure of all those branches would suggest at least a moderate reduction in retail bank services, and that's before we even get to the provisions in Clause 3, which themselves are underpinned by a review into what's happening in retail banking at the moment. And we might take quite a hard look at that, because that touches on the issues raised by my noble friend Lord Kamal on access to banking services for more vulnerable people, and also my noble friend Baroness Morgan on financial abuse and what's happening in the retail bank market. So, just to underpin that so many of these clauses do sit on quite careful inquiry, but this pattern whereby there's a review, there's a recommendation, it winds up in consequential legislation. This pattern means that every single time the FCA acquires more powers, and then we come back to why the FCA has all these powers and what they're doing in these powers and what we can do in Parliament about it, which is why in the last Financial Services Bill we spent so much time on oversight and accountability, and we'll start there with oversight and accountability. Oversight in Parliament for financial regulation has been improved with the last Financial Services and Markets Act, and to the credit of Parliament and the Government, there have been quite important changes with the increase in the MREL threshold in September, the deposit threshold for the leverage ratio in November, and reduction for the first time since the financial crisis in the Tier 1 capital ratio by the Bank of England in December. Oversight in Parliament was at least part of the reason for the change, but as a number of noble lords have said, this bill removes significant parts of the existing regulatory architecture, and this was specifically of concern to my noble friend Lord Howard and was mentioned by Baroness Bowles. In doing so, it transfers considerable power to the Treasury, the FCA and the PRA to design and implement the new regime. Clause 3 adds Henry VIII powers that might create quite unintended consequences. Clause 16, 17 and 18, quite specifically, tend to weaken supervision. We understand the argument that the Minister is likely to make, which is that placing more of the framework outside primary legislation can allow for greater flexibility, speed and responsiveness. But flexibility must not come at the expense of accountability, and simplification must not become a means of transferring major policy choices away from Parliament and into the hands of regulators without proper oversight. The FCA and the PRA rightly enjoy statutory independence from the Chancellor, but that independence makes parliamentary accountability even more important. Their principal democratic accountability is not to ministers but to Parliament, and in practice that accountability is exercised largely through committees in both houses. Turning to regulatory proportionality. The second key concern I have is in proportionality, as discussed extremely clearly by my noble friend Baroness Noakes and also by Baroness Lawler. Commenting specifically on the words of Lady Noakes, she's right to say that proportionality needs to be uppermost in the minds of the regulators. It is the detail of rules, guidance and decisions that matter, not the broad-based strategies. Lack of proportionality can arise, of course, for lots of reasons, perhaps starting with legislation itself. But it suggests a lack of regulatory judgment, which is rather unlucky. Anti-money laundering rules have reached the furthest corners of English life. Alas, as we guard against wickedness in very small financial transactions in this country, there is a degree of quite significant capital flight out of the country going on. The timing of this bill suggests that it may be the last chance for Parliament to set clear guidelines on proportionality before the next government. Only Parliament can do this because financial regulation will default to maximum caution in most instances, with consequences very clearly identified by noble lords this evening. Clause 14 on AML, Clause 39 on ring fencing, Clauses 16, 17 on the 5-year plans, and Clause 26 on changes to the senior management regime are all about proportionality. The government's own 2025 action plan recognises that regulation can be too complex and duplicative, and that the cumulative effects of individually rational rules can impose significant burdens on business, smaller banks, challenger firms, wholesale firms, and those caught by overlapping conduct and redress frameworks. Your Lordship's Financial Services Regulation Committee has also raised important concerns about whether aspects of the PRA's capital approach may limit the commercial incentives and capital available to finance growth. Over-calibration can reduce lending, particularly for SMEs and productive investment, and especially where requirements bear down on smaller, growth-oriented lenders. The bill touches on some of these issues of proportionality, reform of the Financial Ombudsman Service, simplification of the senior managers regime, faster application deadlines, and the consolidation of the payment systems regulator into the FCA. Those are welcome steps. My Lords, we welcome this bill. We hope that through our deliberations in this House, we can help shape a bill that restores confidence, competitiveness, and momentum in our financial services industry for the wider benefit of our economy and our country.
Yeah. My Lords, I'd like to thank everyone who's spoken in the debate this evening for their valuable contributions. It was an incredibly well-informed and a courteous debate as well. They overall recognise the balance that needs to be found to ensure that consumers are protected and risks appropriately managed while avoiding an ever-increasing burden on regulation. And Noble Lords have a range of views where exactly that balance might be. I'll try to respond to many of the points raised as possible in the time that I have, but I'll not be able to do justice to all the points raised today. But I would like a meeting scheduled with many people who have talked today, but I also reiterate that I'm happy to meet anyone that would like to discuss any of the issues and will find it helpful ahead of the committee stage. My Lords, as I've said, the Financial Services and Markets Bill will modernise how the sector is regulated. It will help the sector grow, to lend more to businesses, and it will make consumer protections fit for the digital age. And it will achieve these objectives while maintaining high standards of regulation and oversight. I'd like to remind Noble Lords that this is why, as important as I mentioned when I opened the debate, the financial services sector contributes 8% of total UK GVA, although I've been corrected that the City UK estimates that when related professional services, this rises to 11%. We can all agree it's a substantial part of the UK economy. So the industry is a direct source of jobs and tax revenue, but of course it's much more than that. It's a keen enabler of growth in other sectors and is the provider of payments, credit, insurance and investment service to households and businesses all across the UK. A successful financial service sector is one that meets the needs of the broader economy and, of course, of society at large. And that is what this bill aims to deliver. Before I turn to some specifics, I would like to set out the government position on some of the broader points raised in the debate. A number of peers, including the noble ladies Baroness Neville-Rolfe and Baroness Noakes, asked if it was appropriate to pass more responsibility to the regulators. FSMA 2000 gives the financial services regulators responsibility for making the detailed rules that apply to firms. The regulators operate within this regime set by the government and parliament, including a set of statutory objectives that they need to advance. As the noble Lord Burns reminded us, this is a long-established approach, and the government believes that the regulators remain the most appropriate entities to make rules for the sector. Both the IMF and the OECD support the principle of regulators making rules independently from government. The delegation in this bill is entirely in line with the approach Parliament has repeatedly affirmed. And the government is in full agreement with the noble Lord Eatwell when he notes that the success of the UK's financial sectors depends in part on a highly respected system of regulation and strong, effective regulators. The noble lady Baroness Neville-Rolfe and the noble lady Baroness Bold also asked if the government's use of delegated powers, and especially the power related to the banking services in Clause 3, the Treasury has submitted a full delegated powers memorandum to the DPRRC, which sets out the justification of each power. On Clause 3, in particular, the government is taking this power now to ensure we can respond swiftly to the independent review of access to banking services once it concludes. The government is committed to keeping all aspects of power under review as the bill progresses through the Parliament and as the independent review completes its work. We would expect to narrow this power once the review is concluded. And on the matter of regulatory complexity, the chance has been really clear that the UK needs to regulate for growth and that regulation must be proportionate, while of course adequately protecting consumers and ensuring we maintain high standards which we're known for around the world. This bill targets unnecessary burdensome regulation while maintaining those high standards, and we are focused on speeding up regulated decision-making and removing administrative burdens. The government is committed to creating a regulatory environment that is proportionate, effective and supports growth. And good regulation also supports consumers. For example, the reform of the Consumer Credit Act is designed to ensure consumers receive clearer and more useful information from lenders, empowering them to make better informed choices on their finances. The current framework is prescriptive and outdated. The Literacy Trust has found that 1 in 7 adults has literacy skills at or below those expected of a 9 to 11-year-old. Yet Fairer Finance has found that reading age required for credit card providers' materials range from 11 to 20 years old. It is obvious that a simpler, more flexible regime, one focused on outcomes rather than rigid prescription, which enables firms to produce clearer, more accessible financial information, better meeting the needs of the significant proportion of consumers with lower levels of literacy or numeracy. And the FSA has the experience to design the system to deliver this, and the powers it needs to enforce compliance. I've listened carefully to the concerns from the noble Lady Baroness Wolfe, Baroness Noakes, Baroness Gill and others about changing the application of the regulators have regards, applying them to the long-term strategy rather than the day-to-day functions. My Lords, it is vitally important that the regulators are subject to effective oversight and scrutiny so that Parliament can have confidence they are acting with the appropriate measures and achieving the outcomes required. Much like other areas of regulations that apply to firms, the reporting requirements on the regulator have developed over time and have sometimes laid on top of each other. What results is a detailed set of information, but there are also areas of overlap and duplication and, to use a metaphor also by the noble Lord Thomas, at times it can be difficult to see the wood for the trees. The changes will require the regulators to set out for regulation and supervision clearly, making it easier for Parliament and stakeholders to understand, engage with and challenge. To have regards will remain in legislation. This will support the work the Government and Parliament hold to the regulators to account, cutting out dense, piecemeal reporting to focus on the bigger picture. The reforms will reduce unnecessary and duplicative burdens on the regulators, which allow them to speed up and focus on what's important while maintaining the important information needed for meaningful scrutiny. For example, the bill will require the FCA and the PRA to continue to report annually on how they are advancing their competitiveness and growth strategies. This will support the Treasury's biannual performance reviews, held with the CEOs and the regulators, introduced as part of the Government's wider regulation action plan. Turning now to reforms of the Financial Ombudsman Service, the FOS. The Government is in full agreement with the noble Lord Sharkey and my noble friend Lord Pitt Watson when they talked about the importance of trust. It is absolutely essential that a regulatory system supports trust in the financial services sector and that people have confidence that they will be supported when things go wrong. I can give my noble friend Lord Pitt Watson the reassurance he has asked for that the FOS considers whether firms have met their obligations under FCA rules. This will include principle-based rules, including the consumer duty. The new arrangements introduced by the bill will bring in greater coordination between the FCA and the FOS, will mean that widespread issues can be spotted and addressed more quickly and effectively. For example, if the FCA spots the large numbers of firms are letting down their customers in a certain way, they can make the regulatory intervention to nip that issue in the bud rather than waiting until consumers lose out. I understand that some noble lords have concerns about limiting claims to the FOS at 10 years. Concerns about potential long-term liabilities that are difficult to assess can hold back investment, making firms unwilling to invest or to have certain consumer groups, or to serve certain consumer groups. However, historic complaints also pose significant practical challenges when we look at the lack of availability of relevant evidence on which to base the decision. The Government has conducted a comprehensive cost-benefit analysis when designing this policy. Looking at recent history, only 11% of cases that are older than 10 years result in redress being paid, much lower than the overall rate. In order to assess these claims, the FOS has charged firms £18.1 million per year in case administration fees, while only awarding £600,000 to consumers. So the case fees are 30 times higher than the redress awarded. However, I appreciate the point that some financial products are long-term by design, such as life insurance. Issues with these products may not come to light within the 10-year cut-off. So I'm happy to assure my noble friend Lord Pitt Watson and Lord Davis of Brixton that Clause 6 of this bill enables the FCA to make exceptions to time limit these types of products. This is aimed exactly at ensuring that holders of long-term products continue to be protected. Baroness Kramer raised concerns that the Government is weakening the senior management certification regime. I can assure my noble lords that this is not the case. These reforms are about improving how the regime operates in practice by removing unnecessary complexity to help increase efficiency and effectiveness while preserving the regime's core focus of maintaining strong accountability standards. Firms will remain responsible for assessing the fitness and propriety of senior managers, and pre-approval by the regulators will still be required where regulators determine it necessary to advance their statutory objectives, targeting the regulator's attention where it matters most. The regulators will continue to hold all senior individuals to account where standards fall short. Where there is any tension between reducing regulatory burden and maintaining high standards of senior level individual accountability, regulators will be expected to prioritise the latter in accordance with their statutory objectives. Senior managers will remain responsible and accountable for areas of their business they oversee, including where they fail to take responsible steps to prevent regulatory breaches, regardless of whether they are approved or appointed. My noble friend Lord Pitt Watson and my noble friend Lord Eatwell asked for assurances on the reforms to the ring-fencing regime, and as I set out when I opened this debate, the independent review led by Sir Keith Steock in 2022 concluded that ring-fencing should be retained, but recommended better alignment with the resolution framework. The bill enables that alignment, meaning the PRA will not need to duplicate efforts where protections are already delivered elsewhere, especially through the resolution regime. This fundamental safeguard, the separation of retail banking from riskier investment banking activities, is unchanged. The government will also set out the wider reform programme in the ring-fenced review, which will be published and goes beyond the measures in the bill today. It focuses in particular on enabling ring-fenced banks to support growth, including consulting on a new growth allowance and expanding the range of products and services that they can provide to support UK businesses and the real economy. The Noble Lady Baroness Hodge asked a number of questions about the FCA's new responsibilities for anti-money laundering. I will try to answer them briefly. The government is working closely with the FCA to ensure that they are ready and able to take on new responsibilities. On the question of registration and legal privilege, the Treasury will shortly publish a response to the consultation on anti-money laundering supervision. This covers the FCA maintaining a register of supervised firms, access to legally privileged material and powers to ensure robust supervision during the transition period. A duty of cooperation between anti-money laundering supervisors already exists in the money laundering regulations. OPBAS also has the censure power and can recommend that the Treasury strips PBSs of their supervisory role. The bill provides authority to HMT to make payments to the FCA for proprietary work. Therefore, the FCA's AML-CTF supervisory activities will be fully funded by fees paid by the supervised population. This funding for start-up costs will be fully ring-fenced for these purposes, and the government intends for the FCA's AML-CTF supervisory activities to be funded on a cost recovery basis through its fees charges to supervised firms, consistent with the existing funding model. I expect the FCA to consult separately on the detailed structure and operating of these fees. The Noble Baroness Young, Baroness Hayman and others raised sustainable finance. As they noted, the government has clearly set out its ambition to position the UK as the leading hub for sustainable investment, leveraging our sustainable finance expertise to support transition and to drive growth. The government is working closely with the regulators to drive forward this ambition through work including the FCA's recent consultation on aligning listed companies' sustainability disclosures with international standards, the launch of the Transition Finance Council, and work to regulate ESG ratings. To answer the specific question, Baroness Young, the government consulted last year on how to implement its manifesto commitment to require financial services firms and listed companies to develop and implement credible transition plans. The government is considering next steps and will respond to the consultation in due course. I would also like to make the general point the Noble Lord should not conclude that if something doesn't appear in the bill, it means the government is not doing anything about it. The government has a much broader programme of financial services work sitting alongside the measures in this primary legislation. And I acknowledge the thoughtful questions from Lord Kamal, Baroness Young of Old Scone and Baroness MacLeod about business and community finance, and in the interest of time I will write to them following the debate. And I'll be happy to meet the Noble Lord Holmes to discuss the issues raised related to technology and innovation also. And finally, the Noble Lady Baroness Morgan raised important issue of economic abuse. Tackling economic abuse is a priority for the government and a key theme of the financial inclusion strategy. Ministers would be happy to write to the Noble Baroness with details of how we're working with industry, regulators and specialist organisations to tackle economic abuse and help victim survivors to regain financial independence. My Lords, I have rather breathlessly tried to answer as many questions as I can. I look forward to revisiting all of these points in detail at the committee stage. I beg to move.
The question is, this bill be now read a second time, as many as that opinion will say content. To the contrary, not content. The contents have it.
I beg to move the commitment motion standing in my name on the order paper.
Motion be agreed to. As many as are of that opinion will say content. To the contrary, not content. The contents have it.
My Lords, I beg to move that the House do now adjourn.